Hello guys, good morning. Let's get started. I'm giving you that access to the mic and the camera. Request all of you to please switch on your cameras, guys. Okay, cool. So let's get started. I'll just quickly recap what we did towards the end of the class yesterday, and we'll take it up from there. Before that, request all of you to please switch on your cameras. Sai, Savik, Ansh, Vaibhav, Nandini. Let me share the screen. Right. And let me open the calculator app. Have all of you ordered a physical calculator by now? Not done it, guys. Please do it as soon as possible. Don't continue relying on the mobile application. Okay. Can you see the camera on my screen? Can you hear me now? Okay, cool. And can you see the calculator on my screen? Or the BA2 calculator?
So your
No.
screen is coming as blank.
Wow.
We can see
Okay,
it now.
Now we can see.
oh, is it? Okay. Sorry, I just removed it. Let me put it back. Yeah, you should be able to see it again now. It's coming up, I think. Right? So what we said in the previous class was like these five keys: N, interest rate per year, present value, payment, and the future value. Just to recall, like we did use all the five keys, right? In one of the examples yesterday. Yes, no? And what we said was like, if out of these five things, if you know four things, you can calculate the fifth thing. So in the yesterday's class, we did calculate what is the present value if you know everything else. But now we want to calculate some other components. So let's do this question. Let's say we know everything. We know n equal to 10. We know payment is equal to 5. It means the bond is going to give you 5 rupees every year. Future value is equal to, sorry, the future value is equal to 100, which is nothing but the face value. And the present value is 105. Now guys, try to understand like, the logic here as well. And this is something I'm going to work with you guys very, very often, where I'm trying to tell you like, you can do the approximation. Now, you don't have to do the approximation because you have all the rights to get to the exact answer using the calculator. But many times, even if the question has got too many numbers in the question and the answer choices have all the numbers, and it may look like a calculator based question, but it's not a calculator based question. They're asking for your logic and it's a conceptual question. This is a very good example of such a question. Now, if you do the approximation, one thing is you're fast, you're accurate, and it improves your understanding of the topic. Now, how can you be faster when you do the approximation? Many times the answer choices are far apart. I'll give you one example, okay? Let's say if I tell you that there is a bond which is worth $1,000. The coupon rate is 10%. The market rate or the discount rate or whatever they call it is equal to 10.5%. What do you think is the market value? Answer choices are, sorry, I forgot about the tenure. The tenure is 8 years. The answer choices are A, B, C. Answer choice A is 1045. Answer choice B is 1005. Answer choice C is equal to 980. Can you solve this quickly?
Sir,
C.
Option C.
A.
C, right? Because it has to be trading at a discount. You want 10.5% return, but what you're getting is only 10% return. You're losing 0.5% every year. 0.5% every year would mean that you're losing 5 rupees every year. If you lose 5 rupees every year for the next 8 years, you'll be losing 40 rupees. And the present value of that 40 rupees could be 30 rupees. So 980 looks off. But see, even if it's 980, 970, 960, who cares? There's only one answer choice which is below 1,000, and that has to be the answer. And this is the problem what many people do. They start punching the numbers in the calculator. I don't have a problem. Like you spend the money on the calculator, you should be using the calculator. But if you do it logically, these kind of questions, you can never get it wrong. It can be done in 5 seconds and improves your logic skills. I'll go to the further extent. Let's say this question, let me change the numbers here. Let's say the the face value is 200. The coupon rate is 8%. Market rate is 7%. And the answer choice is the market value is what you have to calculate, the tenure being 5 years. And let's say the answer choices are 190, 202, 208. What do you think is the answer?
Option B.
B.
Option B.
Why?
Because the market rate is slightly lower than the it's 1% lower than
Coupon
the
rate.
current coupon rate, so it will not be like 8 rupees higher than the market rate.
Kyun? Like
Sorry.
when you say slightly, you're getting 1% more every year. 1% more every year, which is equal to 2 rupees.
Hmm.
And 2 rupees every year for the next 5 years is equal to 10 rupees. उस 10 रुपीज का प्रेजेंट वैल्यू 2 रुपीज तो नहीं हो सकता. तो 190 तो इम्पॉसिबल है. 202 looks very far. The answer is 2208. Are you able to follow? So these questions, when you see the answer choices are far apart, should be done using logic. I have a strong opinion about it. The given being, like if you start doing it on the calculator, you can always do some crazy thing in the calculator, which can get you an answer which is like 190.5 because you just punched in some numbers wrongly, plus की जगह minus कर दिया या कुछ भी, like you do something. But this logic thing which I did, you can really get it wrong. This is another example of what we're going to do next. इसके अंदर what they have given is the face value is 100. कितना साल का bond है? Give me 1 second. It's trading at 105. That's fine. And okay, so it's n equal to 5 years, but it's a semi-annual. It's a semi-annual. There are 5 years. So what will be n here? It's a semi-annual for 5 years.
10.
And the coupon rate is 10%. So how much will be the coupon rate here? 10%.
10.
The coupon rate is 10%. So what you'll get every half year will be equal to 5%, right? And they say that the current market value is 105. They're asking you to calculate market rate. We will calculate the market rate, but just looking at it, what do you think? Is the market rate less than 10%, equal to 10%, or more than 10%? What do you think is the answer here?
Less than 10%.
Why do you think so?
More than 10%.
No, actually, more because it is semi-annual, right?
Okay, yeah. The bond
It's
is trading
trade.
at par, premium, or
It's trading
discount.
at a premium, so that means it's more than the market.
Means what is more than market?
The return.
Exactly. So it means the coupon is more than the market. The coupon is 10%.
Should be more than 10%.
No, no, no. See,
Like
follow the
the
logic
market.
correctly.
Trading at a premium, so should be less than 10%.
Exactly. So the reason the bond is trading at a premium is because you are getting more than what you should get. What you're getting is 10. So what you should get is should be less than 10. So the market rate has to be less than 10%. I'll go one step further here. Sorry. That one you are paying 5 rupees today, right, to buy this bond. But at the end of maturity, you'll get only 100 rupees. You're losing 5 rupees over the next 5 years. It means how much you're losing every year. You're losing around 1 rupee every year. That 1 rupee is equal to 1%. So the market rate will be closer to 9% rather than 5 or 6%. I'll repeat. You're buying the bond today at 105 rupees, but at the time of maturity, you'll get 100 rupees. So forget the coupon part. You are losing 5 rupees for the next 5 years. Sorry, you're losing 5 rupees over the next 5 years. If I want to annualize it, you're losing roughly 1 rupee every year. And that 1 rupee every year is equal to 1% roughly. So though I'm getting a coupon rate of 5 plus 5, 10%, I'm losing 1% on the capital loss. So the net return which I'm earning is close to 9%. It could be 8.5, it could be 9.5, but I'll be really surprised if my market rate is 6%. If my market rate was 6% and the coupon rate was 10%, this bond should have been trading at a lot more premium, because then I'm getting 4% extra every year for the next 5 years. And the bond should be trading at 115 or 116 or something of that sort. Let me stop here, but do ask any questions. We'll do the actual work. Don't worry about it. But this is the kind of discussion I want you to have with yourself when you do practice. So let's do this question using the calculator, but I'm sure it will be less than 10%. And when I solve it, I'm sure it'll be closer to 9% rather than 5 or 6%. So let's see what's the actual answer. So in this case, we have converted everything in a half yearly basis. So if I do it, face value is 100. Sorry, the future value. So I'll always start in that order, n equal to 10. So press 10 and then n. The next thing is interest rate per year. This is what I want to calculate. So let's skip that. Present value is 105. Okay. Payment every quarter, every half year I'll get is 5% of 100, which is 5 rupees. So the payment is 5. The future value, like at the end of the tenure, I'll get the face value, which is 100, and compute interest rate per year. Did you talk about error
Sir,
5?
you didn't put the negative for present values.
Yeah. So the minute you see error 5, and this is like, guys, like I almost screwed up my level 1 exams. Because I got this error 5 and I thought like my calculator has gone bad, like during the exam. So error 5, the minute you see it, you should realize that you're looking for a business plan jahan pe you get the money at the start, you get the money during the business, you get the money at the end of the business. So these kind of businesses doesn't work because they must be like stealing money or selling drugs or doing something crazy. A typical business would require some money to be invested and there should be a cash outflow. If there's a cash outflow, you put a negative sign. So in this case, that's the mistake I've done. I'll again start. I'll put 10 is equal to n. Present value is not 105. It's minus 105. This is the money you're giving to the company, not getting from the company. And this is the mistake I did. So I'll put 105 as a present value, but with a negative sign. 5 rupees I put as a payment. 100 rupees I'll get as a future value. And then I'm calculating the interest rate per year. And that is equal to 4.37%. But that's on a half yearly basis. If you want to compound it, you will multiply that by 2 and you'll get 8.74%. So see, it says, note the negative sign for PV input. We must respect the direction of cash flows. If you don't respect it, you get error 5. So error 5, the minute you see it, you should know what kind of problem or the mistake you are doing on the calculator. Okay. Now, another thing is what we call as accrued interest, flat price, full price is what we want to do. Let's say there's a particular bond, and let's be very, very specific about the dates, that there is a 5-year bond issued on 1st July 2023. Let's assume it's an annual coupon bond, just to keep it simple. The face value was 100, or let's call it 1000. The coupon rate being 12%, and the market rate is 12%, just to keep it simple. So the market value is also equal to 1000. So if I assume that for this bond, the market rate always remain 12%, this bond will always trade at par on a day-to-day basis. So let's say one of you, let's say Ria buys this particular bond on 1st July 2023. She will get the interest credited in her account when? Sorry, if you're trying to speak, you're on mute.
1st July 2024.
1st July 2024. It's 1 year, right?
Yes.
So you'll get it on 30th June of 1st July 2024, right?
30th June. Yeah. Correct.
Now, in this case, you have invested your $1,000 for almost 11 months now, right? We are in like the end of May. You think that the market rate can go up. If that's your expectation, what should you do with the bond? Should you buy more of these bonds or should you sell these bonds? If you think that the market rate is going to go up,
Sell these bonds.
sell these bonds. Why?
Once the market rate goes up, these bonds will trade at a discount. Right now, it's at par.
Very good. Now, don't get excited. If the entire market believes that the market rates are going to go up, it would have already gone into discount, right? So you make money in the market only when you have a different expectation from the market and those expectations comes true. So in this case, the market believes that the market rate will remain at 12%. That's the reason the bond is still trading at par. But if you think that the 12% can become 13%, the bond can start trading at a discount in next couple of weeks. So in this case, you want to sell the bond. But the problem here is after 1 month, you're going to get $120. Do you want to lose that?
No.
So you're in a like very difficult situation. Like if you sell the bond, you lose the interest because you won't be the holder of the bond. Or if you don't sell, you lose the money because the market rate will go up and the bond will be sold at a discount. So guys, this is not how it works. In this case, the market value, what you see is a clean price, or this does not include the interest component. इसका मतलब Agar, if this is how it used to work, in that particular bond, nobody will do the trading in the month of June. And in the last week of June, तब तो कोई trading करेगा ही नहीं, because they are going to get the interest in next 1 week. So in this case, the way the trading happens is that if you are a seller, in this case Ria, she will get her $1,000, which is the market value. Plus, she's going to tell the buyer that, hey dude, I've already kept the bond for 11 months. For those 11 months, I deserve 11% of $1,000. Yes, I'm going to charge you £1,000, $1,000 for the market value, but there is an accrued interest concept. What is an accrued interest? That Ria cannot go to the company and say that give me my interest for this year because it's not due yet. But she has earned it for 11 months. So she'll tell the next buyer that, okay, give me $1,000 for the market value, which you believe, which you know is the right value. And the interest which I've earned so far is $110. Why $110? Because she's already kept it with her money invested for 11 months. The next buyer is going to keep his or her money invested only for 1 month and going to get the full $120. So the next buyer will be ready to pay $110 in the form of interest to Ria and will pay $1,110 today. Eventually, this buyer will get $120 within next 1 month. His purchase value will come down towards 1,000. So this 1110 is what we call as full price. What you see in the market is a clean price, which is excluding the interest component. But the actual trading which will happen between the buyer and the seller will be on the full price, which is including the accrued interest. तो शेयर्स में ऐसा नहीं होता है, शेयर्स में सब कुछ ऑल इंक्लूसिव होता है, डिविडेंड वाला पार्ट है वो शेयर्स प्राइस के अंदर इंक्लूड होता है, बट यहाँ पे the interest is over and above the market value. I'll stop here. Let me know any questions.
Ansh, like this 1100 that we are getting is the dirty price, right?
Oh yeah, so you can call it full price. ये एक second, dirty price इसको एक second. Do you have a mention of dirty price here?
No, I just wanted to because
हाँ,
I
तो ये
remember
it's invoice price or dirty price, right? So a full price is called dirty price. So there are lots of terminologies here. तो ये जो clean price है, either you can call it clean price and dirty price. That's one combination. You can call this clean price to be a flat price. And dirty price, you can call it full price. That's another combination. Dirty price, full price, you also call it invoice price because the dealing will happen at that price. Okay, let's keep going on. Guys, but keep asking questions. Don't be shy if there's any question. Okay, now this is a very, very important section. And I'm going to spend lots of time here. It looks like 4 bullet points, but they're very, very conceptual, very fundamental, and you have to get it right. Okay. Before we do this question, guys, humble request, please switch on your cameras and please do keep it on. Thank you, Samay. Waiting for others. Thank you, Ria. Thank you, Vaibhav. Aditya, I cannot see your camera on. Aaron, same with you. Cannot see you. Okay. So now in this case, let's do few things. And let's create a framework first, and then we'll start working around it. Let's say there is a 5-year bond. So the maturity is 5 years. Let's keep it simple. The face value being 1,000, the coupon rate being 10%. Let's assume to get started, the market rate is 10%. So if I go by the logic, the market value will be 1,000. But why it will be 1,000? Let's do some calculation around it. In this case, for the first 5 years, in the first year, you will get 1,000, not the market value wala 1,000, but the face value wala 1,000 into the 10%, not the market rate wala, but the coupon rate wala 10%. You get 100 rupees in the first year, you'll get 100 rupees in the second year, you get 100 in the third year, you get 100 in the fourth year, and you get 100 plus your face value in the fifth year, right? Now, if this is the cash flow you are getting, you'll be discounting it at the market rate. So this will be discounted at 10%, but not the coupon rate wala 10%, but the market rate wala 10%. And if it's the first year, it will be discounted for 1 year. If it's second year, it will be discounted for 2 years. What am I doing? Oh, sorry. For the first year, it will be discounted for 1 year. For the second year, it will be discounted for 2 years. Oh, wow. 1 year, 2 year, 3 year, 4 year, and 5 year. And if I calculate the total present value, that should be equal to the market value. This is what the market should be ready to pay, and that is equal to 1,000 rupees. Do you agree with this framework? Any doubts about it? These calculations and the way I've done it, and why the present value should be equal to the market value? Because any investor who is a rational investor will be ready to pay the present value. Take a look at it. Let me know. Because this is like something I'm going to repeat like n number of times in the entire discussion between today and the last class. Okay, so in this case, let's start with the market rate. Let's say if the market rate goes up to 11%. What do you think will happen to the market value of the bond?
Go down.
Will go down. Can you make a guesstimate how much it will go down?
Um,
Sorry,
by 40 rupees, like approximately.
and why do you say 40? Can you tell me your thinking process behind that 40?
So 10% is 100.
Acha, you're losing 1%, which is equal to $10 every year. So what?
So 50 for 5 years, but we are discounting, so it will be below 50.
Very good. I like that logic. So if I make it 11%, it should go down by 40. Yeah, you're very close. It goes down by 36.96. So if market rate is 10%, the market value is 1000. If market rate goes up to 11%, the market value goes down to how much? 963.04. Very good. So technically, I know that the present value of 10 rupees for the next 5 years is around how much? 37 rupees. Very good, guys. Next question, and think logically. If I make it 9%, what do you think will happen to the market value? Will it go down or will it go up?
Goes up.
Okay, it will go up. The next question is by how much it will go up? Roughly.
I mean, 40 is not this good.
Sorry?
Should be around 45 or 50. Not 50, but like 45. Between 40
Okay,
to 50.
but we just calculated, right? The present value of the next 10 rupees for the next 5 years is equal to what? 37 rupees?
I mean, the market rate is reduced, but the discounted rate also is reduced.
Very good, right? So that's a very, very important point what Sai just made, that when the value went down here, the value went down by 37 rupees. Why the value went down by 37 rupees? Because that is the present value of 10 rupees for the next 5 years. But when I make it 9%, technically you are getting 1% more. 1% more is equal to $10 more every year for the next 5 years. If you are getting 10 rupees every year for the next 5 years and you try to calculate the present value, it won't be 37 rupees. It will be more than 37 rupees. Why? Because those 10 rupees will now not be discounted at 11%. Those 10 rupees will now be discounted at 9%. So I can be pretty sure that in this case, the market value will go up. It won't go up to 1050, but it will go up beyond 1037. The difference between the discount case and the premium case, in both the cases, I'm getting $10 more for the next 5 years. But in case of a discount case, the market rate was 11%. So those $10 were discounted at 11%. But now those $10 will be discounted at 9%. So I'm expecting an answer which is more than 1037, but less than 1050. Is 1038.90. And I'm not surprised at all. So in this case, if the market rate goes down to 9%, the value will go up, but the value goes up more than the decrease. So here the decrease is how much? Here it decreased by 36.96, but here it increased by 38.9. Is it good for the bondholder or is it bad for the bondholder? When market rate goes up, the value goes down, but the declines are less. When the market rate goes down, the value goes up, but the increase is more. It's like best of both the worlds, right? Your losses will be smaller and your gains will be bigger.
So even if it was 11%, would it be, will it be going up by more or?
But see, if it was 11%, then it won't be going up, it will be going down.
Yeah, okay.
The reason it's going up is because it's less. And because it's less, those $10 will be discounted at a lower price, lower discount rate. As a result, the value of those $10 will not be 37, it'll be more than 37.
So,
Yep.
in this case, for the 11% market rate and for the 963.04 market value, can we say this for the inverted yield?
Oh, yeah. So that's one thing. So there are two things I'm trying to do with the same example. One thing is whenever the market rate goes up, the market value goes down. And when market rate goes down, the market value goes up. So this is what we call as the inverse relationship between the market rate and the market value. It means higher the market rate, lower the market value, lower the market rate, higher the market value. That's one thing. The second thing here is that if you increase the market rate, yes, the value will go down because of the inverse relationship, but the declines are lesser. When you increase the market rate from 10 to 9%, the value will go up and the increases are steeper. And this is something that we did in the chart yesterday, right? Like using the paint, that the convexity wala part. Yes or
Yes,
no?
sir. Yes, sir.
So that's convexity. And convexity is good for the investors. The third thing I'm going to do here is let's bring it back to the par 10%, 10%. If 10% becomes 9%, I know what happens. So if it was 10%, the value is 1000. If I reduce the value to 9%, market rate to 9%, the value goes up by 38.9 rupees. Agree? Let's say we are not talking about India where the market rate and the coupon rate are 10%. Let's say I'm talking about the United States where the coupon rate is 3% and the market rate is 3%. Again, because the coupon rate and the market rate are same, the market value will be what? $1,000 because the investor is getting what the investor should get. The investor is getting 3% and what the investor should get is 3%. The bond will still be trading at a par. See, I've done the calculation. The investor is going to get $30 every year and 1030 at the end of the 5 years. And if you discount that at 3%, the total present value is equal to 1000. So guys, this thing works. You take whatever number, you take 4%, it will work. You take 6%, this will work. It took 10%, it worked. Now I'm taking 3%, it works. If coupon rate is equal to market rate, the face value has to be equal to market value. Doesn't matter whether it's 3%, 7%, 15%, 100%, or whatever it is. Simple. Now, in this case, let's say if I reduce the market rate by 1%. In the previous example, what I did was I reduced 10% to 9%. Abhi, I'm reducing 3% to 2%. Can I be sure that the market value will go up? Yes or no?
Yes, sir.
Very good. If I do it mathematically, I'm getting 1% more every year, which is $10 every year for the next 5 years. So in the maximum scenario, it can go to 1050, but it won't go to 1050 because there's a present value. You're not getting 10 rupees into 5 today. You're going to get 10 rupees every year for the next 5 years, and the present value will be less than 50. So 1050 to ho nahi sakta hai. In the previous case, when we reduce it from 10% to 9%, the value went up by how much? 38.9. What do you think will be the value go up in this case when I reduce 3% to 2%? थोड़ा आवाज साफ नहीं आ रहा इस साइड.
It should be in the 40s.
Yeah, it should be in 40s. I love that answer. Because I cannot be sure, like I'm not an Einstein, like whether it'll be 1041 or 1043. But the reason it should be more than 1038.9 is because similar to the previous example, you're getting $10 more for the every next 5 years. But those $10 now won't be discounted at 9%. Those $10 will now be discounted at 2%. As a result, the increase will be a lot more. So I'll bet my money that it has to be something in 1040s. Let's do 1047.13. Is it 1050? For sure not. But is it more than 1038.9? The answer is yes. So in this case, you can read your books. And guys, these four statements are like loaded statements, okay? They just seem like simple English, but there's so much behind it. Other things equal, the price of a bond with a lower coupon rate is more sensitive to change in the market rate than is the price of a bond with a higher coupon rate. So when your coupon rate is 10%, and if the market rate changes by 1%, the impact on the value of the bond is 38 or 39 rupees. But if the coupon rate is lower, and if the market rate changes by 1%, the impact on the value of the bond is a lot more, which is around $47. I'll give you another analogy here, okay? And this is the example I give at many places. That if you are, let's say, a lower middle income class, sorry guys, let's say you're a lower middle income class person and your total wealth is, let's say, 70 lakh rupees. If I take out 50 lakh rupees from your wealth, how would you feel? Devastated, like
Yes, sir.
ruined? Sorry?
Yes, sir. It will feel like collapse.
Yeah. But let's say you are like a multi-billionaire and I take out 50 lakh rupees from your wealth. You won't even realize. So this is the problem with the lower base effect. From 3%, if you take out 1%, it's a big impact. But from 10%, if you take out 1%, the impact is lower. So I'm telling you the logic, but I'm also telling you the technical part, that when your 3% becomes 2%, you're getting 10% more every year. So $10 more every year, but those $10 are being discounted at a lower discount rate, which is equal to 2%. Clear? We'll go back to our 10%. We'll go back to, sorry, let me just put the numbers here. When the market rate came down from 10% to 9%, the market value goes up from 1000 to 1038.9. But when in this case, the market rate comes down from 3% to 2%, the value goes from 1000 to 1047.13. So everything else being same, lower the base, like 10 becoming 9, the value goes up by 38.9, but 3 becoming 2, the value goes up by 47.13.
So can we say that when the numbers are small, the premiums will be more?
No, the impact will be more. Let's say agar 10% becomes 11%, the value goes down. And the value goes down by how much? 36.96. यहाँ पे if 3% becomes 4%, the value will go down, but by more than 36.96. The value goes down by how much? 44.52. Rather than saying it'll go up more, I'll say the impact will be more in either direction. If the value goes down, the value will go down more. If the value goes up, it'll go up more.
Okay.
So basically, the convexity will decide the direction of the bond. Can we say this correct word?
Sorry, it decides the direction. No.
Yes, sir.
So the
No.
inverse relationship decides the direction. I'll tell you. Give me 1 second.
Because these are the value from 36.96. These are the convexity value, right, sir? 38.90 and
Oh no. So I don't even know what is. Oh, okay. How to calculate convexity and all? We are not gone to that part yet. We're just introducing the concept convexity. But how to calculate convexity? We are not done that yet. Okay. So what we are saying is, if I don't know what. I just need like a pen rather than a brush. Do you know how to change it? Yeah, this is a pencil. I'm not able to. Oh, is it like because wide? Oh, yeah. Sorry, get it now. So in this case, let's assume that I'm taking market rate here and I'm taking market value here. Why is it like so zigzag and all? Oh my God. Has any idea how to correct for
So
it?
you had it zoom out, so that's why it's showing some blur.
Oh, अच्छा. ठीक है. So
It's
market
okay.
rate here I'm taking.
It's
You're able to make it out, right? So market rate I'm taking here, market value I'm taking here. So because of inverse relationship, I know that if market rate goes up, market value will go down. This is the inverse relationship. Okay. Convexity says that if market rate goes up, the value decreases less. And when the market rate goes down, the value increases more. The convexity effect says it's just not downward sloping. It's not just inverse sloping, but it's convex as well. Convex means it has its back towards the origin. So there are two different concepts. So this chart shows both the inverse relationship as well as the convexity. Okay, let's move on. Let's take this is the example we have where, and let me set it up to what we started with. $1,000, coupon rate being 10%, market rate being 10%, the market value will be $1,000. No doubt about it. When this is the case, and we know that when market value goes up to 11%, sorry, market rate goes up to 11, the market value falls. And when the market rate goes down to 9%, the market value increases. No doubt about it. This was the setup when the maturity was 5 years. I want to create a similar setup. I just don't want to take a maturity of 5 years. I want to take a maturity of 10 years. Everything else being same, the only thing which is changing is the maturity. So in this case, you are going to get $100 for the next 9 years. And in the 10th year, along with your 100, you'll also get your $1,000, right? And you'll be discounting them at, I don't want to link anything above, I want to link it from here. We'll be discounting them at 10% because the market rate is also 10%. And if I try to look at the market value today, the market value will be equal to the present value of all the cash flow. Doesn't matter, guys, 5 years or 10 years or 15 years. If your coupon rate is equal to market rate, the bond will be trading at par. Clear? Now, if in this case, the market rate goes up to 11%, can I be sure that the bond will be trading at a discount?
no, sir.
No. It will be trading at a discount, right? You should get 11, but you're getting 10. You'll be trading at a discount. What's wrong with that? The question here is, use your logic, how much discount it should be.
Around 90.
Why 90? पहले तो अपना discount was 36.96, right?
Hmm.
The dis
Between 70 and 80, sir. Maybe.
I love that answer, Rishabh. The reason it should be around, it should be more than 36.96 is because in this case also similar to the above case, you're losing 1%, which is equal to $10. But these $10, you're not just losing for 5 years. Now you are stuck with this bond. That's the hard fact, guys. You're stuck with this bond for next 10 years. In the sense that you are going to get 10%, but you should get 11%. And not just for next 5 years, you're suffering for the next 10 years. As a result, the present value of those $10 for the next 10 years will be a lot more than the present value of those $10 for the next 5 years. The present value of those $10 for the next 5 years is 36.96. But if you're losing $10 for the next 10 years, the present value will be more than 36.96. My guesstimate is something between 50 to 60. Let's see. If I make it 11%, the value becomes 941.11 and the discount is 58.89. The same thing, if the market rate becomes 9%, the value will go up, but the increase will be a lot more than 38.9. My guesstimate is like something 60 to 70 ke beech mein. See, it's 1064.18. This is what we call as maturity effect. Longer the maturity, more will be the impact on the value of the bond. Because if it's a longer maturity, you're going to earn that 1% more or 1% less for a longer duration. And in this case, you must just be dreaming, Arey yaar, by chance, agar 30 years bond hota, to I'm done for my life. But you're going to get 1% more for the next 30 years. And the present value of that 1% more for the next 30 years will be even more than 64.18. So this is what we call as maturity effect. Everything else being same, longer the maturity, higher will be the impact on the value of the bond. So this is your third point here. Other things equal, the price of a bond with longer maturity is more sensitive to a change in market rate than is the price of a bond with a shorter maturity. And the fourth one is the convexity, which we already discussed about. That if you increase the YTM, if you increase the market rate, the value will go down, but the decrease will be flatter. When you decrease the market rate, the value will go up, but the increase will be steeper. And that's what we call as convexity effect. So the four things are, one thing is there's an inverse relationship. There's a coupon effect, as in lower the base, higher will be the impact. There's a maturity effect. It means longer the maturity, more will be the impact. And then there's a convexity thing, that with a decrease in market rate, the value goes up much more. And with an increase in market rate, the value goes down, but the decline is limited. So there are lots of qualitative questions in the exam, and without giving any numbers, they will ask you which particular bond will be more sensitive. Now, I don't want any of you to speak on mic, but I want the response from all of you in the chat window or the Q&A window. Let's say there are three bonds, and you to tell me which bond will be most sensitive to change in market rate. Bond A has a maturity of, it's a 15-year bond, the coupon rate of 5%. Bond B is a 10-year bond, the coupon rate of 10%. And there's a bond C, which is a 5-year bond with a coupon rate of 5%. Which bond will be most sensitive to the change in the market rate?
Sorry.
Okay, don't speak on mic. Don't trust whatever he said. Give me your answer without being biased. It's just that, guys, I don't want others to get biased with your answer. That's it. Okay, I've got the response from Ansh, Ria, Aran, Sovik, and Nandini, waiting for others. Cool, guys. So all of you got it right. That's great. Thank you. Gives me some comfort that we are understanding the logic here. So this is what they have shown: the convexity part, the inverse relationship part, the relationship between price and maturity, that longer the maturity, more will be the impact on the price. See, अगर यहाँ पे अगर 1 year maturity, the impact is only 2 rupees. But if it's a 3 year maturity, the impact is 8 rupees. Okay, the next main concept is par value, pull to par concept. Just give me 1 second, guys. Okay, so the next concept is pull to par concept. I can explain you very, very technically, but let's keep it very logical. Okay. तो ये जो 10 year bond की बात करते हैं, this 10 year bond which has a coupon rate of 10%, let's say has a market rate of 9%. ठीक है? So you're ready to sell it for a market value of 1064. So let me put this number, this calculation down somewhere here. And let's say this bond was issued on 1st January 2024. Can you just explain, can we say that in this case, the reason you need $64 is because you were lucky or you were thoughtful that you bought the bond when you knew that the markets are going to go down. Now, because the markets have gone down, whoever owns this bond is going to get $10 more for the next 10 years. And the present value of those $10 for the next 10 years is equal to $64.18. That's the reason you are saying that if anyone wants this bond, you want a premium of 64.18. Agree? Let's say you are now 5 years down the line. You're not on 1st January 2024 anymore. We are setting in 1st January 2029. Now, in this case, it means that for the next last 5 years, you already earned that 1% more and already put that money in your pocket. For the last 5 years, you were getting $100, but you should have got how much? $90. And where did that money go? You already put that money in your pocket. So on 1st January 2029, what is the remaining maturity, or what is the remaining time to maturity for this bond? 5 years. If I come to you and say, hey, can you give me this bond? You cannot ask me for a $64 premium anymore. But the $64 premium was justified in 2024 when I would have got that extra coupon every year. You already enjoyed that benefit for the last 5 years, put that money in your pocket. Now, if I'm buying that bond from you my benefit would be I'm going to get $10 for the remaining 5 years only. So I won't pay you 1064. I'll pay you that above amount, which is 1038.9. Let's say it's not 1st January 2029, it's 1st January 2030. You've already got another $10 extra last year. And now I'm going to get this extra money only for the next 4 years. I'll say, dude, I'm going to get $10 for the next 4 years, and the present value is around 34. I'll give you only $34. If I'm in 1st January 2033, you already like, or maybe 34, or say 33. I'll say, dude, you already got everything you needed, right? You enjoyed the benefit for 9 years. Now the only thing remaining is 1 year. So I'm going to get that $10 extra for the next 1 year. Don't ask me for anything more than $1,009. That's all I'm going to pay you. And that's reasonable, right? I'm not being irrational. Let's say it's not 1st January 2033. We are on 1st July 2033. You already enjoyed the benefit in the form of accrued interest for the 6 months as well. I'm going to get that $10 extra only for the remaining 6 months. I'm not going to pay you anything more than 1004. It's 1st December 2033. I'm going to get $10 extra for next 1 month, which is hardly $1. I'm going to pay you maybe 1,070,000.8. That's it. And if it's 30th December 2033, yes, I'm going to get $10 extra every year for the next 1 day. So I'm going to pay you some premium, don't worry. I'll pay you some premium, but hardly anything. So what I'm trying to say here, guys, is that the reason the premium today is $64 is because to whoever you sell the bond, that person is going to benefit by that $10 for the next 10 years. But as you come towards maturity, the premium keeps narrowing because the maturity or the time to maturity will keep reducing. And in this case, by the time you approach maturity, the value of the bond has to be closer to the face value. Why it has to be closer to the face value? If you go and sell this particular bond to anyone, that person knows that tomorrow I'm going to get $1,000 on 31st December 2033. Why will you sell it for $999? Doesn't make sense when you can keep it for one extra day and get $1,000. And why would somebody else will pay you $1,010 or $1,001 when that person knows that tomorrow I'm going to get only $1,000? So this concept is a very important concept, and this is what we call as pull to par concept. That if a bond is trading at a premium, the premium will keep narrowing in such a way that by the time you reach maturity, the bond will be trading at par. The same thing is applicable for a discount. Let's say this bond was trading at what? What was the value it was trading at if it was a discount? It was trading at 941.11. Yes, if I want to buy this bond and the market rate has gone up to 11%, I want to buy this bond at 941.11. But if it's already 5 years, you already suffered for 5 years. And if I buy this bond, I'm going to get 1% less for the remaining 5 years. I'll be ready to pay how much? 963.04. But as I go closer to the maturity, it'll become 998, 999.5, 999.99. Because if I'm buying this particular bond a day before maturity, yes, I'm going to lose 1%, but for how many days? Just for 1 day. So the discount will be very, very small. And on the date of maturity, the value has to be equal to $1,000. So guys, whether a bond is trading at a premium or a par doesn't matter. In case of a premium bond, the premium will keep narrowing. In case of a discount, the discount will keep narrowing. and by the end of the maturity or towards the maturity, the value of the bond will be closer to $1,000. And this concept, as I said, is called pull to par concept. This is how it works. If it's 108, it'll go towards 100. If it's 85, it'll go towards 100. Assuming that the market rate doesn't change throughout the tenure. I can give you some more advanced chart if there's a change in the market rate in between, but this is assuming that the bond has a coupon rate of 6% and the market rate of 3%. It means the bond will be trading at a premium. But with each passing year, the premium will keep narrowing. In this case, the coupon rate is 6%, but the market rate is 12%. The bond will be trading at a discount, but the discount keeps narrowing.
Ansh, one question here. The market rate is very volatile, right? And if that be the case, then how can we achieve such a uniform curve? So I'm
Yeah.
assuming that 6% market rate is not going to remain consistently over the entire tenure of the bond. It may be going less high, whatever. I mean, there could be some swings and ups. So is this the real picture, or this is from the
No. It's a very, very theoretical picture. So let me give you a real picture, how it'll work. And thank you for asking that question. So in this case, let's assume the coupon rate for a bond is equal to 10%, right? And let's say the market rate is equal to, sorry guys for this italics or whatever font it is, but looks very weird. And the market rate is 8%. Okay. So in this case, I know that the bond will be trading at a premium, and over a period of time, it'll go towards a par. So let's say this is $100 ka line. So over a period of time, it'll go towards par. But I get your point. This is assuming that the market rate remain 8% throughout. If the market rate does not remain 8% throughout, how will it work? In that case, today the premium is more. It'll start from here. But let's say all of a sudden there's a decrease in market rate further. The market rate goes down to 7%. The bond value will jump up. Again, it'll start going towards par. Let's say there's an increase in market rate. The bond value will fall and again go towards par. Let's say there's a decrease in market rate, the value will jump up and again it'll start going towards par. You getting my point? If there's an increase in market rate, the value will fall. Again, it'll start going towards par. Let's say the market rate increases more than the coupon rate. The value will come here and again start going towards par. This is how the cycle will be. So you can like completely displace it because of the change in the market rate, and there'll be a step jump or a step decline. But eventually, again, from that point, it'll start going towards the par.
Understood. So this clarifies, Sanch. So at any point, so we were also calculating the market value considering the percentage remaining constant towards the balance tenure of the bond. So I don't know from an exam perspective where they'll be asking these kind of questions, but if the market rates jumps like this, then all of a sudden the discount rates, everything what we used in that market value calculation also keeps changing parallelly, right?
Right. So in this case, what happens is that we don't assume that the market rate will remain constant throughout the tenure. And there's an estimate which we are going to go to an advanced level. that we will see that acha, what is the market expectation for the next 1 year? What is the market expectation for next 2 years, 3 years, 5 years, 7 years, 10 years? And we are going to get that complication in our calculation a bit later.
Understood. Yeah.
Hello? So yes, like we are making a very big assumption that the market rate of 8% remains same for the next 10 years. And I showed you that chart, right? Like the upward sloping and the inverse curve, yield curve in the last class.
Yep.
Obviously, they are not going to remain same. They're going to increase or decrease or whatever it is. But in this case, we are assuming that it remains 8% throughout the tenure. Yes, Rishabh, I understand. Your body language tells me a lot. We'll go for a break, don't worry. So it's 10:30. We'll be back at 10:50 and then continue. Okay. Okay, so let's get continued where we left. Any questions on this pull to par concept? Now, this is a concept of matrix pricing. It's a very subjective thing. So in this case, let's say there is a particular, when do we use matrix pricing? When it's like a bond where you know the coupon rate, where you know the credit rating, where you know other stuff, but you don't know the market value. The reason you don't know the market value is because it's not traded in the market, or if it's traded in the market, it's very, very illiquid. मतलब there's some trading happened on 15th of May, and then from 15th May से लेके अभी तक 25th May तक there's no trading happening. Like on some day of the month, there'll be some trading happening, but you have no idea what is the share price or what is the bond price over the last 10 days. So in those cases, we use matrix pricing to calculate the market value. Now, guys, if you understood the concept so far, for a bond which is not trading in the market, do you know the coupon rate? Yes. Do you know the face value? Yes. But do you know the market rate? No. अभी तक अपन क्या कर रहे हैं? From market rate, we are calculating the market value. But in real world, you know the market value, so you can calculate the implied market rate. Because market rate is not the repo rate. The market rate is the interest rate what you would want to get for that particular bond from that particular company at that particular point of time with a particular interest rate with a particular maturity. Right? And this can change every minute, every second, as we discussed. So is there a place where you can find the market rate for each and every bond? No, there's no such place. You get the market value of these bonds from the exchange, and because you know the market value, you can calculate the implied market rate. And this is a main difference, that in academic exercise, we use the market rate to calculate market value, but in the real world, you know the market value. As a result, you calculate the market rate. So for these bonds which are illiquid, which are not trading in the market, you don't know the market value. If you don't know the market value, you do not know the market rate. So somebody told me once, like, sir, okay, they're not trading in the market, but we know the market rate. The market rate is driven by market value. Is that part clear? So for these bonds, we don't have the market value. Because we don't have the market value, we don't have the market rate. Then how do you get an idea how much you should be paying for these bonds? So we use a very, very subjective, easy approach to try to value these bonds. So let's say you want to value a bond which is a 4% annual pay A plus rated bond that has 3 years remaining until maturity. So what are the key characteristics here? Coupon rate is around 4%. It's a A rated bond with a 3 years maturity. So what I'm doing here is I'm trying to see which are the other bonds trading in the market, which are A rated bond. So there's a bond which is number 1, number 2, number 3. These 3 bonds are trading in the market. All 3 of them have a A plus rating. Very good. Now the problem here is that I'm looking for a 3-year maturity. The bonds trading in the market either have a 2-year maturity or a 5-year maturity. But what do I want? I want a 3-year maturity. And within 5-year maturity, there are 2 bonds. One is paying 5.1%, the other one is paying 5.3%. And we know that longer the maturity, higher the interest rate, given the maturity risk. Remember, you're not ready to lend me the money for next 20 years, but you kind of still agreed to lend me the money for next 1 month. But you are not sure what will happen to me over the next 20 years. How will my behavior change? How my health and wealth change? So in this case, how I'm going to use these three bonds, which I know the market value of. And because I know the market value, I know the market rate, which is nothing but the YTM. So in this case, I'll say, okay, these three bonds have a similar credit rating. Now let's get the 5-year thing done first. There are two bonds which have a 5-year maturity, but one is offering a market rate of 5.1%, the other one is offering 5.3%. I don't know what's driving it, but let's take an average of these two, which will be a representative of a typical 5-year bond come market rate. So I don't want to take 5.1, I don't want to take 5.3, I'll take an average of these two, which is 5.2%. Okay? The YTM here is how much? 4.3%. What is the difference between a 2-year maturity and a 5-year maturity? The gap is 3 years. And going by these three bonds, it implies that a 2-year bond is getting a 4.3% and a 5-year bond is getting a 5.2%, which is a gap of 0.9%. इसका मतलब with each 1 year higher maturity, longer maturity, the market rate increases by 0.3%. तो अपने को 3 year का निकालना है, so the answer would be 4.6%. Guys, it's not scientific, it's very subjective, but this is the only way we can calculate the YTM of a bond which is not trading in the market. And once you know the YTM of that bond, you can calculate the market value, what you should be ready to pay in a private market.
Sir, can you explain second step again?
Okay, so sorry, I was just like a bit lazy. I was not doing it on the Excel sheet. Let me do that. So the credit rating is same across all the bonds. There are two bonds with a 5-year maturity. One is 5.1%, the other one is giving 5.3%. So I'm saying that, okay, let's take an average of these two. So it means that a 5-year maturity is giving us 5.2%. There's a 2-year maturity bond, which is giving us 4.3%. The gap between 5.2 and 4.3 is equal to 0.9%, and the gap in the maturity is 3 years. I'm saying that for each additional year of maturity, the market rate changes by 0.3%. So I know that 2-year maturity has give 4.3. So I can draw a table kind of a thing that, okay, 2-year is giving me 4.3%. 5-year is giving me 5.2%. So if I want to complete this table, I can say that 3-year will give me 4.6% and 4-year will give me 4.9%. The question is asking what a 3-year maturity bond the YTM will be. The answer is 4.6. If the question was around 4 years, the answer would have been 4.9. If the question was around 3.5 years, it would be between 4.6 and 4.9, which is 4.75. So like you're doing the extrapolation simply. A reminder for everyone to please switch on your cameras.
Ansh, can you please show me the formula once more?
किसका formula?
This extrapolation formula.
अच्छा, तो extrapolation का formula is 4.3 plus 0.3, another 0.3. So you know that 2-year versus 5-year, the gap is 3 years and the difference is 0.9%. मतलब हर year there's a gap of 0.3%.
And how that 0.9 came?
So I know that a 2-year maturity has a 4.3%, 5-year maturity has 5.2%. So the difference is 0.9% and the difference in the maturity is 3 years. So the every year is equal to
Okay, we are calculating every year how much.
Yeah. So this is a matrix pricing. When to use matrix pricing? When you want to value a bond which is very, very illiquid or not trading in the market. But for
Ansh,
matrix pricing, yeah, sorry.
Ansh, this method works even if the bond gradings are different?
No, then again you'll have to make more adjustments. So let's say if there was a double A rated bond and there was a triple B rated bond, and double A rated bond was giving you, let's say 6%, sorry, 4%, and triple B was giving you 4.2%, then you'll assume that with each one credit rating decline, there's an increase of 0.1%. And what we want a A rated bond. So I'll add another 0.1% to it.
Okay.
So can there be a situation where they give us all this data and a data for a C grade bond just to confuse us?
They can give, so then just ignore it. But see, all I'm trying to say is that this is not a scientific method. But you don't have a choice.
Will this matrix pricing method will be applied to perpetual bonds?
Yes, if you have other bonds which are similar bonds which are perpetual bonds.
Similar bonds as in I didn't get.
Okay, so here this was one of the, we are using matrix pricing here, but what we want to value is a A rated bond. So I could find other 3 A rated bonds which are trading in the market.
Got it.
So if you can find other 3 or 4 or 5 set of bonds which are perpetual bonds trading in the market, yes, you can do that. But you cannot prorate a 2-year and 5-year into a perpetual thing. I think this is where your question is coming from, right?
Yes, correct.
Great. So let's go on further. I want to do a couple of questions. Wow, how do I remove this? Oh, wow. Let's do question number 1. Now, I don't want you to do it on the calculator yet. We'll do it on the calculator, but before we do on the calculator, any question you get in a CFA exam, answer choice A, B. So लोग क्या करते हैं? Like they just look at the question because this is the question. But guys, the answer choices are also part of the question, and they're there to help you.
So we can't see the full question.
Cannot see the full question as in?
The line gets cut off.
अभी देख रहे question number 1.
Like towards the right.
वो ऐसा? अच्छा, एक second. Maybe now?
Yeah. Others.
अभी better है?
Yes, sir.
Okay. So saying that generally people look at the question and that's about it. They don't look at the answer choices. Look at the answer choices, you'll get a better idea what the question is actually asking you. What do I mean by that? Many times, as I told you in one of the examples, that you can eliminate 2 answer choices without even solving the question. This is what I call as easy question, because if you can eliminate 2 answer choices, you know what the answer is. A typical question would be you can eliminate 1 answer choice just using the logic and the approximation. But to eliminate the second answer choice, you need a calculator. This is what I would call as a typical question in the exam. And a third category is a difficult question. Even if you apply your logic and the approximation, you cannot eliminate even a single answer choice. And as a result, you need a calculator and a further work to do anything further on this. Now, if you can eliminate 2 answer choices, you're done. If you can eliminate 1 answer choice, it's still good, right? That you know that your probability of getting the question right is now 50% rather than 33%. And let's say if you do something crazy while putting the numbers in the calculator or stuff, you know that that cannot be the answer choice. So let me stop talking. Think about question number 1. What do you think can be the answer or cannot be the answer? And be honest to yourself, don't touch your calculators yet.
C cannot be the option.
Why?
Uh, because the YTM is more than the coupon rate, and in this case, let's say we assume the price of the bond as 100, then the market rate will be less. So 82 as compared to other numbers is on the higher side, like somewhat close to 100.
Okay. So first of all, because the market rate is more than the coupon rate, I know for sure that the bond will be trading at a discount. In these cases, guys, you automatically assume, given the answer choices, that the face value is 100. If it was question number 2, though it's given in the question, the value is 1000, you assume it's 1000 pounds. Okay. So in this case, if the face value is 100, I know that the bond should be trading at a discount. So just because you know that the market rate is more than the coupon rate, you're not able to eliminate even a single answer choice. So it's not that easy question. But I agree with Ria's part that given the difference between the market rate and the coupon rate is 5%, you're losing 5% for the next 20 years. Theoretically, you're losing 100%, but the present value will be not 100%. 5% into 20 years. But the present value of those 5 rupees for the next 20 years won't be just 18 rupees, right? Will be a lot more than 18 rupees. As a result, yes, A or B could be the answers. C cannot be the answer here. Now, what is the answer between A and B? Unless you are Einstein, please don't use further approximation because it's too difficult to choose between 68.5 and 68.7. Use the calculator, you'll get the answer. Make sense? Let's do question number 2. Oh, by the way, I didn't even bother about calculating answer here, but you know how to do it, right? That was not the purpose of doing the question. Question number 2. The minute people see it, acha semi-annual hai, acha N will be 10, acha the coupon rate will be 5% every half year. Arey, wait a minute, wait. Read the full question and see whether the question even wants you to do the calculation or not.
So yield to maturity is the market rate. Yeah.
Yes, YTM, market rate, yield, everything is same.
Answer should be A, right? So that's also more than.
Oh, did you do the calculation?
No, I mean like both the other answers are above 1000.
Exactly. So you know for sure that in this case, given the market rate is more than the coupon rate, the bond has to be trading at a discount. Wow, such an easy question. There's only one answer choice, which is less than 1000, which is answer choice A. Who cares it's semi-annual or quarterly? Who bothers whether it's a 5-year or 15-year? I know that it should be trading at a discount. That's it. So this question is like covered as a typical calculation based question, but no, it's shouting out loud, hey, I am looking like a numerical quantitative question, but it's a conceptual question that if the market rate is more than the coupon rate, is the bond trading at a discount or a premium? If it's a discount, answer choice is A. No further thing required on this. You saved almost a minute because you don't have to do anything on the calculator. And you can do crazy things on the calculator, still get an answer which is 1189 and 1193. But given the logic you applied, you can be 100% sure that the answer choice is A. Is that logical? Fair? The question number 3, I won't even bother about doing it. It's simply asking that there's a decrease in the market rate. What will happen to the value of the bond? Obviously, it will increase. So let's skip that. Very easy. हाँ, यहाँ पे आप देखो, the coupon rate is 5%, the YTM being 6.5%. What will be the value increase over the next 3 years? These kind of question you have to do. See the answer choices: 13.62, 13.78, 13.96. Please do this question. Don't use approximation. Question number 4. Sorry, question number 5. An investor paid a full price of 105, almost $106 for a bond issue. The purchase was between coupon dates and the accrued interest was 2.354. What is each bond's flat price?
Answer B.
Yeah, so it has to be like 105.9 minus 2.35. So that is to be around 103.55. Okay, so please guys use approximation. Don't start punching the numbers on your calculator yet. That's my only key takeaway from a couple of questions we have done. So let's go to the next topic. It's about yield and yield spread measures for fixed rate bonds. So how to calculate the yield to maturity? And I said yield to maturity is same as the market rate, is same as the IRR, is same as the uh, discount rate. All these are like one and the same thing. If it's a semi-annual, you assume that rather than getting $7 every year, you'll get $3.50 every half year. So your N will become double, your coupon rate or the payments will become half, and you can calculate the implied YTM, but you have to double that YTM because this will be a half yearly and you have to double it to get the annual one. So the number of bond coupon payments per year is referred to as the periodicity. So it could be an annual bond. It means it'll give you a coupon once in a year. It could be a semi-annual. It'll give you twice in a year. It could be a quarterly, which will give you 4 times in a year. It could be monthly, which will give you 12 times in a year. But generally, it's semi-annual when it comes to the US. Okay. Now there are few things. What is current yield? And there are other 3 yields. Current yield, yield to call, yield to worst. Just like let me see what is not covered in level 1. I get confused many times with level 1 and level 2 stuff. So don't want to teach you something from level 2 yet. Simple yield. Okay. Now in this case, let's say a particular bond says that, hey, you will get 10% coupon. Okay. So, and let's say it's a semi-annual, it means you'll get 5% every 6 months. Clear? Now, in this case, let's say that that 6 months fall on a weekend or a public holiday. So the payment will be made the next day, the next working day. Now, in this case, the street convention says that given the coupon rate was 10%, you're getting 10% return. But because the payment did not happen exactly at the end of the year, because the end of the year was a Saturday, so the payment happened on Monday, which is 2 days later. Technically, your return is not 10%, your return is less than 10%. But kitna kam? You're just losing it by 2 days. So the return could be 9.98%. So in this case, the true yield is calculated using those actual coupon payments is what we call as true yields. Because if the coupon dates fall on the weekends and the holidays, coupon payments will actually be made the next business day. So though you'll think like you're making 10%, but you're not making 10%, you're making slightly less than 10%. Why? Because you lost the interest on that money for 2 days. Like, "Arey yaar, kya chindagiri hai?" You know, like, why do we bother about this? But guys, generally the people investing money in this securities is huge, right? Millions and billions of dollars. And people investing money into it get a fixed rate of return. Why they want to lose like a few thousand or a few $1 million just because of this rounding off errors? That's the whole logic. I remember how frustrated my father was when the UPI and like NEFT and RTGS started, because we have to make the payment to the supplier. And now, like, if you make the payment, let's say on Friday, it gets debited from our bank account on Friday. You understand where I'm coming from? Otherwise, my father will issue a check on Friday, and rather than using DTDC or FedEx, we will use the slowest thing on the India Post. Will The check will reach after 3 or 4 days in the same city, and after 3 and 4 days, when it goes for clearing, the amount will get debited only after 5 days. You save that much money for 5 days. And I'm like, how does it matter? But if you're talking about a few lakh rupees, and if it's your day-to-day thing, you want to save that money, right? And my father was smart. Like, if let's say one of my supplier is Sai, and I know that he has an HDFC bank account, I'll issue him an ICICI bank a check. So it takes another 2 days to get it cleared. And if Rishabh has ICICI bank account, I'll give him HDFC ka check. And the best thing is, my father had an account in Bank of Baroda. Oh, there's a bank called Bank of Baroda, by the way. Like, I don't know, like, who else has any of you have an account with Bank of Baroda? Yeah, my father has it. He'll issue the check of Bank of Baroda to everyone. So, like, it always takes like a few more hours or a couple of days extra to get that check cleared. But RTGS, NEFT, my father is like frustrated. Or I make the payment today and it gets debited from my account today itself. So this is the thing, right? So it matters whether you're getting the payment on Saturday or the next Monday. So what is current yield? Current yield is simply that how much you are paying to buy the bond and how much you are receiving every year is your current yield. Let me do it using some numbers here. Right. So in this case, let's say the market rate is 11%. Let's assume market rate is 11%. So if you buy this bond, how much you will pay if you want to buy the bond today? Will you pay 1,000? Will you pay 963.04? Will you pay anything more than 963, less than 963? How much will you pay? I see raise of hand from Sovic. Any questions? Sorry, I just saw it.
No, it was by mistake.
Okay, no worries. How much will you pay to buy this bond today?
Sir, lower or equal to market value.
Yeah, you are a typical buyer. Why will you like? Okay, you want to get lower than 963.04, but why will somebody sell it to you for less than 963.04? But I agree with your thought process that you won't pay more than 963.04, and I fully agree with that. But I'm saying that look at from the seller's perspective. Why will the seller will give it to you for less than 963.04? So yes, you will give exactly 963.04. Agree? How much will you receive every year? You'll receive 10% of 1,000. It won't be 11% because you get the coupon payments on the coupon rate. And you get 10% of 1,000, not 963. So you'll get $100. So in this case, you'll receive $100 every year on the payment of 963 rupees today. As a result, your current yield would be equal to 10.38%. So current yield is how much will you pay to purchase the bond and how much coupon will you get every year. So the payment you'll make is the market value and the payment you'll receive is coupon rate into face value. And as a result, this 10.38% is what we call as current yield. And guys, current yield will always be between market rate and coupon rate. I can further expand it. If the bond is trading at a discount, I know that if the bond is trading at a discount, the coupon rate is less than market rate. And I told you that current yield will be somewhere in between. So this is how the equation will look like. The current rate is lower than the current yield. Sorry, coupon rate is lower than the current yield, which is lower than the market rate. If the bond is trading at a premium, I know that the coupon rate is more than the market rate. And I know that current yield is somewhere in between. This is how the equation will look like. How do I make sense of it? In this example, the market rate is more than coupon rate, right? So the bond is trading at a discount. So though the market rate is 11%, and I'm getting only 10% return from the bond, but guys, because today I'm buying it at a discount, which is 963 rupees, but at the time of maturity, I'll get $1,000. I'm getting 10% on the basis of coupon. And did I invest $1,000 to get that 10%? No, I invested only $963. So as a result, my current yield will always be more than 10%. Let's say if it was a the bond is trading at a premium. In that case, see, my market rate is 9, my coupon rate is 10, and the current yield is between 9 and 10, which is 9.63. Because in this case also you're getting $100, but to get that $100, you have to pay a premium which is more than $1,000. So I've seen many questions, they make it a numerical question, but they're simply asking you, they're telling you the bond is trading at a discount. They'll give you coupon rate, they'll give you current yield, and they'll ask you to calculate the market rate. And there's only one answer choice where the market rate is more than the current rate, sorry, current yield as well as the coupon rate. And that's your answer. So the only one thing you have to remember is current yield is always between the coupon rate and the market rate. I'll stop here for a few seconds. Ask me questions. Guys, any comments, any reactions? Okay, so let's continue. Now there's something called yield to call, yield to put, yield to worst. So what happens is that we discussed about the callable bond, right? What is the callable bond? Can you remind me, please?
Issuer
Company
can
that issues
call
the
the
bond
bond anytime they
bond
want.
back.
And when you say you, like who? Sovi, can you keep your mic on mute if you're not speaking? Thank you.
Sorry.
No
Like
worries.
callable bond is like the issuer can call back the bond whenever I think the market rate is lower than the current coupon rate.
Then ulta. The market rate is more than the coupon rate. Because issuer, the company is paying, let's say, coupon rate.
Sorry, market
And
rate
they
is
know that the market rate is higher. They're happy, right? They're paying only 10% when the market rate is 12%. So they'll buy the bond back when the market
like
rate is,
they will call when the market rate will be lower than the current coupon rate, right?
sorry, you're right. So when the market rate is lower than the coupon rate, the company will be like, "Arey, why am I paying 10% when the market rate is just 8%?" And if the market rate is lower than the coupon rate, it doesn't make sense for the company to continue paying 10% when they can easily issue a new bond at a lower market rate, which is 8%. And you know, right, what happens when the market rate is lower than coupon rate? The bond will be trading at a premium, but the company has an option to purchase it back at face value or a pre-decided price. So in this case, we know that the company can call it back, and we know that the company will call it back because it's very rational decision for the company to call it back. So in this case, we don't calculate YTM. We don't calculate what is the return you'll get if you hold the bond till maturity, because the company will come and take the bond back from you as soon as it becomes callable. So let's say if it's a 5-year bond, the company is saying that, okay, for the first 2 years, I can't call it, but after 2 years, I can call it back at $101, right? So you try to calculate what is your IRR, what is your YTM, sorry, what is your yield or what is your return if you hold the bond only for 2 years, and after 2 years, you sell the bond at $101. Understood? So in this case, YTM is assuming that you hold the bond till maturity. In case of yield to call, it's assumed that you hold the bond only till the call option is exercisable. Let me take an example here. Let's say there's a bond with a 5-year maturity. Not a plain vanilla bond, but it's a callable bond. And what are the rules and like the agreement about callable bonds? The company can call it back anytime after 2 years. It means there's a lock-in that for the next 2 years, the company cannot call it back. At what price? Sorry, guys. The company can call it back at $101. Let's say the market value of this bond is 105. The coupon rate is 10%. So the question is asking you what is the market rate or YTM, or sorry, yield to call or the IRR on this bond. So the way I'm going to do it is, for all practical purpose, I'm going to do two calculations here. One is assuming it's a plain vanilla bond, n is equal to 5, maturity is 5 years. At the time of maturity, what do I get? 100 rupees, which is my future value or the face value. My payments are equal to 10%, which is 10 rupees. My market value, which is the present value, is equal to 105. I'll try to calculate what is interest rate per year. This question will give me YTM. I'll do another question, what we call as yield to call. In case of yield to call, I won't take n to be 5. I'll take n to be 2. Because I'm assuming that after 2 years, the company will call it back. And when the company call it back after 2 years, my value I'm going to get from the company is not 100. As per the agreement, I'm going to get 101. payment will be 10 rupees for next 2 years. The present value is still 105. I'll calculate what is the interest rate per year. Now, simple logic here is that if your YTM here is, let's say, is equal to 9%, your
It's
YTM here,
8.7, sir.
oh, thank you, 8.7. So I was not very wrong on my approximation. And what is the interest? What is the YTM here?
Should be between 8.7 and 10.
Or maybe may not be. Like it depends. Like because I would reduce this 100 to 101, right?
Okay.
So let's say it's 8.6%. इसका मतलब क्या है कि if the company call it back after 2 years, your YTM comes down. And your YTM is nothing but the cost to the company. So the company will call it back for sure. So what we do is we calculate YTM, we calculate YTC, which is yield to call, and we take the worst of these two. Why do we take the worst of these two? Because the company will buy it back. Guys, give me 1 second. Sorry, guys. So you calculate YTM, you calculate YTC, and you take the lower of the two. And the lower of the two is what we call as YTW, yield to worst. Matlab, you will get the lower of the two. The reason being you don't have an option, the company has an option. And why will company pay you more when the company has an option to pay you less? I'll stop here and time for a quick feedback in the sense that how you're finding the difficulty level, which will tell me to slow down, go at the same pace, or to speed it up. On a scale of 1 to 10, 1 being easy, 10 being difficult, how do you feel? Please put that in the Q&A window. 1 being easy, 10 being difficult. Okay, wow. I'm surprised like lots of you who are not even communicating a lot are like still at 4 and 5, which is good. I thought I've already lost a couple of you guys, as in like you lost the track. Great. Anyone who is like, when I say, when a couple of you say 6, I'm assuming that's still manageable. Like it's a bit challenging, but not like you're not understanding anything. Is that a fair assumption? And let me call out Vaibhav, Ansh, how bad your 6 is. Like you're getting a slight headache.
Just a slight headache, but just have to listen.
You don't say it, man. You just like,
Yeah.
okay. But are you able to make sense? Like, as in, I'm sure like you'll have to go back and do more work. But are you able to make sense in terms of what we're discussing? And is it logical?
Yes, sir.
Okay. Cool, guys. So I think we'll continue with the same pace. We won't increase the pace for sure. So we discussed about the callable bond and the puttable bond already. And we said, if you remember, that the callable bond will always be worth less than the straight bond value. Straight bond value means a plain vanilla bond with no option. Why the callable bond will be worth less compared to a straight bond?
Because
So
the
it becomes
benefit is
less.
on the issuer side.
Yes, the issuer has an option, and the issuer will exercise the option when it's beneficial for the issuer. As a result, is a loss to you. So in this case, the difference between the callable bond and the straight bond value is the value of the call option. But you don't have a call option. The call option is with the company, right? So technically you bought the bond from the company, but you left the option behind with the company. So whatever is the value of the option, you want to take a discount for that. Make sense? But if it's a puttable bond, the value of the puttable bond will be more than the straight bond value. And what is the difference? The difference is equal to, oh, they've not given the formula conveniently. So if it's a puttable bond, the formula will look like puttable bond value is equal to straight bond value plus put option value. Why there's a plus in case of a put option value? Because the put option is with me as an investor. So I'm buying the bond from the company. Along with that bond, I'm also getting the option on the bond. So guys, puttable bond value will always be more than the straight bond value, and the callable bond value will always be less than the straight bond value. And the difference is nothing but the value of the option. In case of callable bond, it's the call option value, but because the call option is with the company, it's a minus sign. And in case of put option value, because it's with the investor, there's a plus sign. So let's do one quick example, okay? Let's say there are three bonds, A, B, and C. The credit rating for these three bonds, same. The company issuing the bond, same. The maturity of these three bonds is same. Country these three bonds are in, same. Guys, everything is same, okay? I'm just like, you ask me everything, I'll say everything is same. Bond A is giving me, and if you ask me the risk-free rate of return in the country is, let's say, equal to 6%. If I give you a bond which is giving you 5.5%, what do you think about this bond? Any critical comments?
Bad investment.
Sorry, bad investment. Why?
It's less than the risk free.
Right. So in this case, I can calculate something called spread. How much this bond is giving you over and above the risk-free rate of return. A spread is minus 0.5%. If you're getting 6% without taking any risk, why will you ever agree for 5.5% with some risk into it? So it's whatever you do in that economy, because the risk-free rate of return is 6%. If I give you a business pitch or an investment pitch, and after 2-hour pitch, if I tell you that, hey, the return will be anything less than 6%, it was an utter waste of 2 hours. However good the pitch is, the reason being anything less than 6% is irrational for you to even think about. So guys, you always look for a spread which is a positive spread. So in this case, if I tell you that bond A is going to give you 7.5%, spread is 1.5%. Still, is it a good investment? Maybe not. Because you'll try to think that whether this 1.5% extra spread is compensating for the risk you are taking for the time of investments and blah, blah, many more things. So in this case, this is the YTM and this is the spread. If your benchmark is a risk-free rate of return, you want the spread to be positive. But guys, you can take a benchmark to be something else. Let's say you take the benchmark to be a triple B rated bond. And for a triple B rated bond, your interest rate is 9% in that economy. I can calculate the spread compared to the triple B rated bond as well. Can that spread be negative? Yes. But if you're taking the benchmark to be risk-free rate of return, the spread can never be negative. So let's say bond A is giving you 7.5%. So the spread you are getting compared to the risk-free rate of return as a benchmark is equal to 1.5%. Bond B is, let's say, giving you 7.8%. Bond C is, let's say, giving you 7.75%, and bond C is giving you 8%. So the spread you are getting here is 1.5, 1.7, 2%. So guys, in this case, the credit rating is same, the company issuing these bonds is same, the maturity is same, the country is same. Which bond will you buy? Bond A, B, or C?
C.
Why?
It's giving more return.
So yes, you'll simply go with the spread, which is bond C, which is giving you the highest yield, highest spread. And this spread is what we simply call is like, the spread, like compared to what you're getting compared to the risk-free rate of return. Are you sure, like, are you ready to bet your money on this, that you'll buy bond C? Anything you want me to ask before you invest into bond C? I already told you that the credit rating is same, the company is same, the maturity is same, the country is same, the default risk is same, the collateral is same. Anything else you want to ask?
The tenure.
Coupon rate.
Tenure is same, the maturity is same.
Coupon rate.
Sorry?
Coupon
Coupon
rate.
rate is same. Rate is same.
Sir, they're callable or not?
Yes, that's one thing you must ask me. So Rishabh has already put all his money into bond C without inquiring whether it's a callable bond or a puttable bond. But think about if I tell you that, hey, call a bond A is a puttable bond. Sorry. Give me 1 second. Yeah, bond A is a puttable bond. Bond B is a plain vanilla bond or a straight bond, they call it. And C is a callable bond. If you buy a callable bond compared to a straight bond, is your risk more or is your risk less? Compared to bond B, bond C will be
More.
higher risk, more risk is there. So we call it a call cost or the option cost. Why there's an option cost? Because the company has an option against me. So we use it as a minus sign, right, to calculate the value of the bond. It means it's a cost to me as an investor. And let's say if I assume that the value of call option cost, and guys, I'm repeating why I'm using the word cost here, because I don't have an option, the company has an option here. So the value of call option cost is, let's say, equal to 0.4%. In this case, though you're getting a spread of 2%, but of that 2%, 0.4% is because you are taking a risk associated with the callable bond. So actual spread you're getting is just 1.6%. And this is what we call as option adjusted spread. Out of the spread of 2%, only 1.6% is the actual spread you're getting. 0.4% तो तुम्हें मिल रहा है because you're taking the risk associated with the callable part. In case of straight bond, is there any option? No. So the option adjusted spread is equal to 1.75% because there's nothing to be adjusted for. And in case of puttable bond, you're getting a spread of 1.5%, but along with that, you are getting a value. What is the value? That you can put the bond back to the company whenever you want it. And that value is equal to, I'll call it put option value. Why it's a value? Because you are getting it in your pocket. Let's say the put option value is also equal to 0.4%, just to keep it simple. In this case, I'm getting 1.5% plus I'm getting a luxury to sell the bond back to the company management, which is worth another 0.4%. So on an option adjusted basis, the actual spread I'm getting is 1.9%. Sorry, Rishabh, you already put all your money into bond C. Do you want to change your decision now in the hindsight?
Yes, sir.
So guys, never ever take a decision based on the spread. Look at the option adjusted spread. If you're looking at a plain vanilla bond or a straight bond, option adjusted spread and the spread will be same. But if there is a callable or a puttable or any other option on the bond, look at the option adjusted spread. And guys, we call it OAS, option adjusted spread. Okay, so let's go on. So we discussed about the option adjusted price and the option adjusted yield. In case of price, you adjust for the call cost or the put value. In case of option adjusted yield, you adjust for the percentage, which is 0.4%. Okay, now in this case, this is what I was talking about. The spread is nothing but how much more or how much less you're getting compared to the benchmark. But if your benchmark is the government security, we call it G spread. And the G spread cannot be negative because what can be safer than the government bond? But the benchmark spread can be negative because the benchmark can be anything. A yield spread in basis points over a government bond is also known as a G spread. In case of a G spread, it says that the spread is compared to a benchmark, which is a government bond. If a benchmark government bond with exactly the same maturity as the riskier bond does not exist, interpolation should be used to estimate the appropriate maturity. Same thing, matrix pricing, you can do that. But remember guys, G spread negative hona is not possible. Okay, let's go on. There's something called zero volatility, option adjusted spread, and the nominal spread. So what we've calculated so far is a nominal spread, but now we are going to discuss about zero volatility spread and the option adjusted spread. So what is the nominal spread? The difference between the YTM and the benchmark is the normal spread or the nominal spread. But we are going to get into zero volatility spread. How does it work? What it is? Let me tell you. Give me 1 second if I already laid out the example in one of the other files. No, okay. So let's do this. And Rishabh, it's coming to your question that all of this while we are assuming that the market rate remains constant throughout the tenure. Now what we're going to do is we are going to take the next step here. Let's take an example that there is a bond where the face value is 1,000. The market the coupon rate is equal to 10%. The market rate is equal to 11%. Well, let's start with 10% for the time being. The the market value I'll calculate. Let's say the maturity is 5 years. I'll just lay out the framework which we already had in this case. So that's equal to this 1000 into 10%. You'll get 100 rupees every year. At the end of the maturity, you'll get your 1000 rupees back as well. So this is your cash flow. Present value will be equal to this 100, and I'm assuming that this 10%, the market value, remains constant for all the years. That's my assumption, right? I look 1 year down the line, 2 year down the line, 3 year down the line, it's always 10%. That's my assumption. And the present value will be equal to 100 divided by 1 plus 10% to the power of 1. The present value is 90.91, 82.64, and all of it. So my market value is equal to the sum of all the present values, which is equal to $1,000. We have done it in the past, but I'm just like breaking down that the assumption here is that if I'm sitting today, if I look at 1 year down the line, I'm getting 10% return. That's my expectation. 2 year down the line, it's 10%. That's my expectation. 3 year down the line, 10%. That's my expectation, and so on. And because I'm expecting 10% every year, my YTM is also equal to 10%. Okay. Now, in this case, let me try use my guesstimate skills and still get to 1,000 value today. Okay, but the way I'm going to do it is the market rate is not 10% throughout. The market rate here is 9% here, 9.5% here, 10% here, 10.5% here. Okay, 9.5 here, 9.75 here. Oh, sorry, 8 here, 9 here. Sorry, guys, I'm just going to do approximation for some time. Please. Guys, please bear with me. Oh, thank God. So in the above case, my assumption is that the market rate remains same at 10% forever for the next 5 years, 1 year down the line, 2 year down the line, and I'm getting a present value of 1,000 rupees. Okay. In the second case, my assumption is that my market rate will be 7.95%, which is less than 10% initially, but it'll go about 10% eventually. And guys, your maximum payment here is coming in the 5th year. So this 10% being different from 10% matters a lot. This number being different from 10% doesn't matter much because I'm just getting 100 rupees in this case. Is that fair? So what I'm saying is, in both the cases, my market value is 1,000 rupees. It means that my YTM, if I hold the bond till maturity, I'm getting a 10% return. The difference between the above case and the below case, in the above case, I'm assuming that you get 10% as a flat line throughout all the 5 years. That's your assumption, Rishab. That's what you highlighted, right? But in the below case, I'm saying that sitting today, market believes that for the next 1 year, the interest rate will be 7.95. 2 years down the line, the interest will be 9.6. 3 years down the line, it will be 9.75. 4 years down the line, it will be 9.9. And the 5 years down the line, it will be 10.1. But still, because the face value is equal to market value, it means the YTM here is still equal to 10%. But it's just that you're not getting 10% every year. Some years you're getting less than 10%, other years you're getting more than 10%. But on an average, your YTM is still equal to 10%. Is that fair? Let's say I tell you that this particular bond is going to give you 1% extra spread over 10%. So abhi current yield kitna hai? 10%. Let's say I'm saying that you'll get a spread of 1% more. Instead of 10%, you'll get 11%. Clear? If you get 11% rather than 10% in this case, what I'll do is I'll increase this 10% with 11%. I'll increase the spread by 1%. The value becomes 963.04. Oh, sorry, let's not make it 1%, let's make it 2%. Okay, so I'll make it 12%. In this case, in the below case, I'm going to do the exact same thing. I'm going to increase the discount rate or the market rate for each and every year by 2%. But in this case, because I know the interest rate for each and every year, I'm going to increase the interest rate for each and every year by 2%. Let me do it another 2%. Oh, sorry. What is happening? Oh, sure. I'll increase all the numbers by 2%. What did I do? In the above case, I increased the YTM by 2%. And increasing the YTM by 2% means that I increase each and every year interest rate by 2% from 10%. My value becomes 927.90. But in the below case, because I knew the interest rate for each and every year, which is different across all the years, I did not increase the YTM by 2%. I increased the interest rate for each and every year by 2%. And guys, in this case, my YTM is equal to 12%. I can be sure. Why? Because every year I'm getting 12%. But in this case, see the market value. Here the market value is 927.9. Here the market value is 928.07. इसका मतलब यहाँ पे your YTM is not 12%. Your YTM is, according to me, maybe 11.95%. I'm just making it up, but it has to be less than 12%. What I'm trying to say here is the spread above, in the above example, is what we call as a nominal spread. You add the nominal spread to the YTM and see what is the present value of the bond. But the below example is what we call as a zero volatility spread. You do not add 2% to the YTM, you add 2% to each and every year's market rate. As a result, the implied increase in YTM may not be 2%, but anything different from 2%. It'll be very close to 2%, but it'll be slightly different from 2%. So in this case, we call it a nominal spread of 2%. Here we call it a zero volatility spread. In short, people call it Z spread. You're not adding 2% to the YTM, you're adding 2% to each and every year's market rate, or the spot rate we call it. I'll stop here, take a look. Let me know any questions, any comments. I'm happy to repeat all of it again.
So can we do the same example where YTM is 8% and the
Yeah,
bond trades at premium?
yeah, let's do that. Thanks for making my life difficult.
Ansh, like I have one question. Like, why it is called zero volatility spread? Like, any
So you're
reason?
not just assuming that the market rate remains same.
But
You
then
are
we are considering volatility, right?
अच्छा वैसे क्या ओके वो मेरे को I don't know मतलब technically the above one should be called as the zero volatility.
Yeah.
तो वैसे तो you in this case you're saying that even if I don't know, that's a fair question. But the below one, the zero volatility spread is the actual scientific way to calculate the spread. ऊपर वाला is a rounding off, is an approximation. Because if you're getting 2% extra every year, that does not mean that you're getting 2% extra on the YTM. You're getting only 1.95% extra on the YTM. If I want to do it for 8%, in that case, my market value here is 1079.85. And if I want to reduce 2% from the initial numbers, remember it was 7.95 will become 5.95. It was 9.6 will become 5.6. In that case, see the value here, 1079.85. Here the value is 1079.65. So here my YTM is 8%. Here my YTM will be, I think, slightly more than 8% because I'm today buying it at 1079. So my YTM could be 8.02%. Deducting 2% versus like deducting 2% from the YTM is not same as deducting 2% from each and every year's spot rate. Between the nominal spread and the okay, so guys, here the nominal spread is minus 2%. And the zero volatility spread is also minus 2%. What is more scientific? The zero volatility spread. What is being used in the real world? The zero volatility spread. But the nominal spread we generally talk about because it's easy to discuss, it's easy to qualify. But no one uses the nominal spread. This is what is being used in the real world. Okay, so we'll take a break, but before that, any questions, any comments on this part? So in this case, it's a method for deriving a bond's yield spread to a benchmark spot yield curve that accounts for the shape of the yield curve. So here I'm taking an upward sloping yield curve. कि 1 year के अंदर spot rate is 1 year के अंदर is 5.95, 2 year के अंदर is 7.6, 3 year में 7.75. So I'm taking the upward sloping yield curve into consideration. But यहाँ पे I'm not taking the yield curve into consideration. Option adjusted spread we talked about. So the option value is nothing but the difference between the Z spread and the option adjusted spread. Recall the question we did above. Let's say this is Z spread and this is option adjusted spread. So if my option adjusted spread is more than Z spread, it means it's a puttable bond. If my option adjusted spread is less than Z spread, it means it's a callable bond. If both are same, it means it's a straight bond. That's exactly that doing here, guys. Don't see it as a formula. Simple funda is option value is equal to Z spread minus option adjusted spread. If OAS is more, it means the option value will be negative. It means it's a callable bond and vice versa. Okay? Great. Let's do a couple of questions, or let's take a break and then do a couple of questions. It's 12:12. We'll be back at 12:30 and then continue. Okay, guys, welcome back. May I request all of you to please switch on your cameras so I know that you're back.
Ansh, I have one question. Like, are those things part of level one? Like what we generally do in 409A valuation, like valuation of each share class and all those sort of things.
409A.
Like I mean, like preferred share valuation or ESOP valuation.
No, like there's some qualitative comment around it, but no. Like in equity investment, the valuation is very, very limited in level one. And what you're talking about, the valuation of the ESOPs and all, that's not even part of level two.
Like those are like they have just made qualitative comments on them.
Oh. Okay, let's do question number 2.
Sorry.
Okay, so first of all, I want you to think through it logically rather than doing the question itself. So what we are saying is that the coupon rate, what you'll get is 7.125%. But to get this coupon, you won't be investing 100, you'll be investing more than 100, which is 102. So roughly मेरे को on the investment of 102, if I get 7 rupees, 7.1 rupee, roughly मेरा 7% return आ रहा है. Is that logical? The second part is today I'm buying the bond at 102.35. But after 2 years, I'll have to sell it for what? 101. So technically, I lost 1 rupee 35 paisa over the next 2 years, which is equal to roughly 70 paisa every year, which is equal to 0.7%. So I'm getting roughly 7% from the coupon, but I'm losing 0.7% because of the decrease in the value of the bond. What do you think could be the answer?
Option B.
6.3. And see, this is what I was telling, and sorry to pinpoint on you, Rishabh, on this. I know that you did it on the calculator and you got the answer 3.2, but because that's wrong is because it's a semi-annual and you forgot to multiply by 2. And this is exactly the point I want to make, that if you do it logically, there's no room for those silly mistakes you can do on the calculator. So when you do the logical part, it's quick and the accuracy is close to 100%. And why did I prefer to do it approximation? Because see, the answer choice is 3, 6, and 9%. Nothing against the BA2 calculator is good, but still try to minimize the usage. As a perfect example, the kind of mistake you can do when you do it on the calculator. Question number 4. What's the answer for question number 4?
G spread option.
G spread.
G spread. It's option A because it's compared to the government bond. So that's the reason we call it G spread. Question number 5.
Lower.
Lower because if you're getting 1.5% in the form of Z spread, adjusting for the option you should be getting more than 1.5 because callable bonds are more risky. So yes, you're right. It should be lower. So for both question, sorry guys, what am I saying? It says higher, hence the Z spread, which includes the impact.
Could be higher, right, Ansh? Because like for callable bond, we will have to subtract some call option value from the Z spread.
हाँ sorry तो अपने ये जो किया था, this is a callable bond, right? So the option resisted spread is 1.6, so the Z spread will be more than 1.6, which is 2%. So once you adjust for the option, you're removing the risk of the call. So if you're getting 2% out of the 2%, 0.4% is because of the call risk. Once you adjust for that, it's equal to 1.6. So the Z spread is, sorry, if the Z spread is if the option adjusted spread is 1.6, the Z spread will be more than 1.6. My bad. Okay, so let's go to the next topic. And we'll talk more about the yield and the yield spread measures for a floating rate instrument. May I request all of you to please switch on your camera? Somehow I can just see Rishabh's camera on. Is it just me or I don't know what? Yeah, I can see Souvik now. Vaibhav, Anushka, Samay. Ria.
How much is left in fixed income?
Sorry? What was your question, Souvik?
I'm just asking like how much is left in fixed income?
Okay, let me show you like the broader agenda, like where we are in terms of how much is left and what we have done so far. So we are done with like 49, 50, 51, 52, 53, 54, 55. We are currently trading 56, which is a quick one. And the total number of readings we have got is still 67. So we have got a long way to go. But the only thing is some of the topics as we go further will be much shorter compared to what we have done so far. Like for example, credit analysis for corporate issuers. We won't spend like more than half an hour on this. Credit analysis for government issuers is like a very quick one. We won't spend too much time. So, like some of these topics like 62, 60, 64, they're theory and we'll spend less time on these. So they should be done very fast. But the topics we are going to get into, the bond duration and the bond convexity, they are very, very, like typical, and we'll spend more time on those. We are in like the third class for fixed income or the second class? Third, right? So we may need one extra session. We'll see, like, we'll explore that at the end of today's class, like how much we are done and how much we are left with. And then I'll request the institute for one extra class. So don't think that, we'll be able to complete all of it by the end of next class, if that's your concern.
Yes.
Okay. But I don't want to hurry it up, because if you try to do everything fast, you end up doing nothing. I'm a strong believer into that. And you'll see, right, I'm still skipping a few things because I just want to make sure that you understand the core, so that other things you can still do it by yourself. But can we have like 7 or 8 sessions for fixed income? That's not worth it. So I'm just trying to do the fundamental part. But please, guys, make sure that just because you've seen the recording or you attended the class does not mean that you're done with fixed income. You still have to go read it line by line, and you have to digest it yourself.
Like by when, like we are expecting to complete the whole syllabus, and like
Yeah, like simple funda is like which all topics you're left with, and how much is the percentage of those topics in your exams. So each 10% will take 1 weekend. That's or maybe like each 7-8% will take 1 weekend. So let's say if you're left with 5
maybe like
topics,
July end or August 1st.
I don't know which all topics are left. If you tell me, I can help you with that.
Equity investment, portfolio management, economics, and maybe 1 or 2 topic here and
So economics is 4 or 5. So economics is 4.
Economics, portfolio management, fixed income, and derivatives.
Right. So let's say
equity
fixed income will be
investment.
done by next weekend, which let's say the first week of June, we are done with that. Economics is 2 weekends. Portfolio management is 1.5 weekend. And derivatives, you said, right?
We also have equity investments also, right? In the level 1.
Yeah, we have equity investment. So I don't know which all topics you're done with and which topics you're left with, actually. That I'm not sure. So equity investment, portfolio management, and economics. These are the 3 ones.
And derivatives.
Derivatives.
And derivatives. Okay, so derivatives, 3 sessions, economics 4, 7, 10, 13. I think it'll go like August mid tak.
Okay, no issues.
I doubt it'll be done by July end, if you're left with these many topics. Okay, so let's go to reading number 56. Request for all of you to please switch on your cameras, guys. Don't be camera shy. It's okay. It's just like us. Anushka, Nandini, Ria, Samay.
Ansh, my screen keeps freezing if I keep the camera on. Not sure if it's internet related or Zoho related.
Is it? Okay. Great. Now, guys, like the way I say it is like, we are done with the core, like, the fundamental part of fixed income. We'll build up further on that, but I'll catch up a slightly more speed. you'll find me like skipping some more topics, because like if we try to end up doing everything, we'll end up doing nothing. So I'll just focus on the core part. Now we are shifting from a fixed coupon note to a floating rate note. What do I mean by that? Let's say in this case, I want to take an example, but I don't want to take this. Let's take one of the previous examples we did. Let's create one. Let's say the face value is 1000. The coupon rate is 10%. Let's say the market rate currently is 10%. So what is my market value is what I'm trying to calculate here. And let's say the maturity of the bond is 5 years. Okay. In this case, it's 1, 2, 3, 4, 5. In the first year, you'll get 1000 into 10%. The second and the third and the fourth year, you'll get the same money. In the fifth year, also, you get the same money. And along with that, you get your $1,000. You've done this drill so many times, guys, you should be very comfortable with this. So this present value today, to calculate the present value, the discount rate I'm using is the market rate. And the market rate here, the present value here is 90.91. If I do it for all the 5 years, I'll get the present value, and the market value here would be equal to 1,000, right? But the beauty of the fixed income is that this 10% is fixed. Why do I call it a beauty? Like, as in, if you are an investor who thinks that the risk associated with the company can go up, what you'll do is you'll short the bond today. Because when you short the bond and the market rate actually goes up to 12%, the investors will be stuck with 10% and the value of the bond will go down. And because you've done the short on the bond, you'll make money out of it. But if you think that the market rate can go down, it means the company is in a tough situation today, but the company can improve quite robustly over the next couple of years. You'll invest the money in the company today so that if the market rate goes down to 8%, the value of the bond will go up and you'll make lots of money out of it. Right? But what if I tell you that this coupon rate, which I assumed to be fixed so far, fixed means whatever happens to the market rate, the coupon rate won't change. But now what I'm saying is, if the market rate comes down to 9%, the market coupon rate will also come down to 9%. If market rate goes to 11%, the coupon rate will also go to 11%. This is what we call as floating rate notes, where the coupon rate also changes along with the market rate. So these kind of bonds will generally trade at par because there's no difference between the market rate and the coupon rate. And the people who invest into these bonds will never make money from the capital gain or the capital loss. The money they are going to make is equal to the market rate, which they will get in the form of the coupon rate. We'll get into more details, but one important thing here is, will this bond always trade at par, or is there a possibility that these bonds can trade at a discount or a premium?
Maybe they are callable or puttable.
Forget the callable and puttable. Let's say these are straight bonds. Or you cannot call it a straight bond because the coupon rates are floating. So there's some flavor into it. What do you think? Will they always trade at par? Because the market rate will, sorry, the coupon rate will be adjusted to make it equal to the market rate.
So those changes will be every quarter or every month. It won't be every day.
Very good. Nice one, Rishabh. So let's say if these changes are every quarter. So let's say the market rate changes on 10th of April. and the readjustment will be done on 30th June. So for those 70, 80 days, you'll be generating that 1% extra return or 1% lower return. But you're getting my point, right? 1% extra or lower return just for those 80 days is a very small amount. So there'll be a slight premium or a slight discount. But when it gets readjusted, it'll come back to the par. So these bonds can trade at a slight discount or a slight premium between two settlement dates. But again, the premium or the discount will not be too much. The premium or the discount will be a very small amount. So with that context, in this case, valuation of a floating rate note, then we see like the premium and the discount will be very, very small. I talked about. Yes, there's nothing much, like you can read through it, like there's a couple of calculation, but that's the main thing I wanted to bring to your notice, which we already discussed. Okay. So let's do the main work and let's go to the core topics, which is duration and convexity. So we'll talk about the spot, par, and the forward curve. Let me explain you what is spot curve, par curve, and the forward curve. I'm going to use the terminology about the forward rate 0, 1. What does it mean? That if you invest your money today, which is 0, for the next 1 year, which is number 1, the rate of interest in the market is 8%. If I say F02, it means you're investing your money today, which is 0, for the next 2 years, which is number 2. Let's say your rate of return is 8.5%. I can use the terminology F1, 1. Can anybody tell me what is F1, 1?
For like I will be investing my money next year for a duration of 1 year.
You'll be investing your money after 1 year for one.
I mean next year for a duration of 1 year.
Yeah. So you're talking about the second year here.
Yes.
Okay. Now, in this case, this is what we call a spot rate for 1 year. Because you're investing money today for next 1 year. So whenever you're investing money today, we call it a spot rate. So this is a 1 year spot rate. This is a 2 year spot rate. And this is a forward rate because you're not investing money today, you'll be investing money after 1 year. This is just an estimate. You don't know after 1 year whether you'll get this or not. You may get it, you may not get it. But these are the current rates. You can go in the market and get this return then and there. So guys, these are actuals. This is just an estimate, which may come true, which may not come true. Now in this case, let's say, if you invest money in the market today, you get 8% return. If you invest the money in the market today for the next 2 years, you get 9% return, let's say. Which one will you choose? Investing money in the market for 1 year at 8% or investing money in the market for 2 years at 9%? And don't bother too much about the maturity risk because let's say you're investing the money in the government bonds. So you can trust the government not only for next 1 year, but also for next 2 years. There'll be some increase in the risk, but let's not bother too much about the maturity risk. What will you prefer? Investing for 1 year and get 8% or investing for 2 years and get 9%?
2 year and get 9%.
Very good. I don't disagree with that. Higher the better. But if everyone is choosing a 2 year spot rate, everybody is investing in a 2 year bond, the market value of the bond will go up. It'll be trading at a premium. So today you'll pay 102 rupees, but after 2 years you'll get only 100 rupees. So technically, because these bonds will become expensive, the return you will get on these bonds will come down. And nobody is buying these bonds. So the value of these bonds will go down. So you'll buy it at a discount. As a result, the return on these bonds will be higher. So what we're trying to say here is that let's assume that this 8% and this 9% market is indifferent. They're equally happy investing for 1 year and get 8% return. And they're equally happy to invest for 2 years and get 9% return. Which sounds a bit counterintuitive, that why people are okay with 8% return in 1 year when they can get 9% for the next 2 years. Let me draw it, okay? Let's assume that if you take root 1, in root 1, what you're doing is you're investing money for the first year, you're investing money here, and if you invest money here, you get 8% return in the first year. That's it. If you take root 2, invest into a F02, and you'll get 9% for the next 2 years. And I'm saying that you are indifferent between root 1 and root 2. How is that possible? If I take root 2, and sorry guys, I'm going to do a blunder here. Like I won't do the compounding. Let's keep it simple for now. If you invest money for 2 years, if you're getting 9% every year, how much will you get in 2 years? Forget the compounding part. Let's keep it simple. 18% over the next 2 years. And I'm saying that the investors are indifferent whether to invest for 1 year at 8% or invest for 2 years at 9%. It means somehow they think that if they take route 1, they'll get 18% return. It means that they believe that after 1 year, for the next 1 year, which is the second year, the interest rate in the market is equal to 10%. Guys, if I know that my F01 is 8%, if I know my F02 is 9%, my F11 is equal to 10%. Because the reason the market is indifferent between F01 of 8% and F02 of 9%, it's only possible because market believes that after 1 year, if I invest the money, I'll get a 10% return. Now, who will choose route number 1? People who believe that the forward rate after 1 year can be more than 10% will choose route number 1. And who will choose route number 2? Who believe that the forward rate after 1 year for the next 1 year can be less than 10%, they will choose route number 2. But the market, it means 90 out of 100 people believe that it will be equal to 10%. So you have to have a differentiated view to prefer route number 1 or route number 2. If your differentiated view comes true, you make money. Otherwise, you will lose money. So guys, this is how you calculate the forward rate if you already know the spot rate. Does it make sense? Stop here for a few seconds.
No doubts, Ansh. You can continue.
Okay, just give me 1 second. Cool. So in this case, what I did was just like a very logical, simple calculation. But guys, in a fixed income class, this does not fly. How can I add 9%, 9%? Remember geometric mean if you've done the quants class? Or I have to do the compounding. What do I mean by compounding? That if I take root 2, at the end of 2 years, I don't have 18%. How much I have at the end of 2 years? I'll have 1 plus 9% into 1 plus 9%. The total money I have is 118.81%. As a result, if I take root 1, I need the same 118 point. Like I need my, well, let me minus 1. So my total return is equal to 18.81%. So here also I need 18.81%. How much did I get in the first year? I got 8% in the first year. So as a result, how much do I require in the second year is equal to 1 plus 18.81% divided by 1 plus 8% minus 1. Sorry guys, I misguided you. The answer is not 10%, the answer is 10.01%. But the reason I misguided you is because you understand the logic of it without getting into the formula. And the second thing is many times the answer choices are 9.5%, 10%, 10.5%. Trust me guys, straight away, you can do the calculation if the answer choices are far apart. You need to get into the formula if and only if the answer choices are very, very close. You might be concerned that how did I get the formula? Keep it very simple. Let's say if for next 2 years you're getting 9%, let's call it X. And the forward rate for 1 year is Y. So you want to make sure that in this case, what will be your total return? Oh, sorry. In this case, your total return will be equal to 1 plus 9% whole square. Here, we don't know this. And this is what we want to calculate, right? What is the forward rate after 1 year for 1 year? So in this case, for the first year, I'll get 8%. And in the second year, I'll get 1 plus X. In this case, I'll get 1 plus 9% to the power of 2 because I'm getting 9% for both the years. Here, I'll get 8% in the first year and I'll get X in the second year. Do you agree with that? And I want to make sure that this is equal to X. All for it, I can say 1 plus X is equal to 1 plus 9% whole square. Sorry, let me just keep it as a formula rather than solution. Divided by 1 plus 8%. So what will be X? X will be equal to 1 plus 9% whole square divided by 1 plus 8% and minus. But guys, it's not a formula. You can just do it yourself. You can derive it. So all I'm trying to say is that the people we are discussing in this particular classroom are the people who are rational investors. And a rational investor will choose route 1 if that's a better route, or they'll choose route 2 if that's a better route. But because I'm telling that the market is indifferent between both the routes, it means at the end of the 2 years, both of them should give you the same rate of return. So this 1 plus 9% का whole square should be equal to 1 plus 8% into 1 plus X. What is X? Is nothing but the forward rate after 1 year for the next 1 year. Okay, so let's do a quick exercise. If I tell you that F01, sorry, F03 is equal to 9%. If I tell you that F01 is equal to 8.5%, can you tell me what will be F1? And I need an answer in next 15 seconds. It means I don't want you to calculate. I want you to think through it. F03 is 9. F01 is 8.5. What is F12? And don't use mic. Please post your answer in the Q&A window. It's more than 30 seconds, guys. I thought like I'll get answer from at least a couple of you. If I invest money today for the next 3 years, I'm going to get 9%. That's F03 means. If I invest the money today for next 1 year, I'm getting 8.5%. What is the forward rate after 1 year for the next 2 years? It means that here in case of route 1, you're getting 8.5% in the first year. If you take route 2, for the next 3 years, you're getting 9%. What is the expectation for the market to get the return in the second and the third year? Oh, sorry, I think I've got some answers. I didn't realize it. So, Souvik, Varun, and Vaibhav. Yes, correct answers, but Vaibhav, I won't take your answer. Seems like you calculated it. I want an approximate answer without calculation. But yes, you're right. But I want to focus on the understanding part. So in this case, what did we do? That if you take route 2, you're going to get 27% return at the end of 3 years. If you take route 1, you're getting 8.5% return. So the remaining 18.5% should come in the second and the third year. And every year you should get 9.25%. This is the logic without doing any calculations. But if I do the calculation in route number 1, I'll get 1.85% in the first year. And for the second and the third year, I'll get 1 plus x ka whole square. Here I'm getting 1 plus 9% ka whole cube. It means this should be equal to this. Or 1 plus x to the power of 2 should be equal to 1 plus 9% to the power of 3 divided by 1 plus 8.5%. Let's solve it. So 1 plus x ka whole square would be equal to 1 plus 9% ka power 3 divided by 1 plus 8.5%. And that is equal to 1.19. What is 1 plus x will be equal to? 1 plus x will be equal to the square root of this. What will be x? X will be equal to this minus 1. Sorry guys, I was wrong. It's not 9.25. It's actually 9.2509. So it hurts me, when people do the calculation, they get an answer 10%, 11%, 8%. Even without doing it, I know it has to be very, very close to 9.25. So it serves two things. Many times the answer choices are far apart. You don't need the calculation. And by doing this, you understand the logic. Before you get too excited, I've seen in the exam, the answer choices are 9.2509% versus 9.2487% and 9.2562%. So in that case, you don't have a choice but to actually solve the question. But if the answer choices are 9.2509 versus 8.5046 versus 9.7568, then you know that it's just like a camouflage. You don't have to solve it. It's a logical question and you can mark A and move on. Just give me 1 second, guys. Yeah. No, so like, see, the thing is, I'm going to Hiranandani to meet a friend of mine. Yeah, I thought I'd just drop by. Just like a couple of things to confirm and because the disbursement is on Monday, I just wanted to know like everything is in place and just like letting you know the documents I require and all of that. Yeah. No, my no difference. Yeah. So if you can, in the meantime, if you can ask Puneet whether he has got the approval from Bank of Baroda. Puneet is the loan guy, right? What he want to know? Okay. Yeah. So can you check like internally, like if we have got the approval from Bank of Baroda? Because the Bank of Baroda person told me that they got the approval, like they have approved the project. I just wanted to verify this from Lodha as well. That have they verified, like has Bank of Baroda verified Lodha? No, so the project has been approved as per Bank of Baroda. My loan has been sanctioned. This is what Bank of Baroda told me on Friday late evening. So they are saying that they disperse the money on Monday. Yes. No, I did it myself directly, but Puneet sir obviously helped with getting all the documents and giving where what is required to the bank. Yeah. 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 So because I'm coming there, I'll just like drop by and see you like for 10 minutes. Sorry guys about it. Okay, so in this case, once you know the spot rate, you can calculate the forward rate. How do you do that? We just discussed about it. If you make a chart with the spot rates, we call it a spot curve. If you make a chart with the forward rates, we call it a forward curve. As simple as that. There's something called par yield. Par yield is like just if you want the bond to be trading at par, what should be the yield is what we call as par yield. It's just very, very theoretical concept. I don't think we'll be using it elsewhere in the further topics. But forward rate, as I said, is a very important part. Like in this case, if you're getting S as the spot rate for the next 3 years, that should be equal to what is the 1 plus S, like the spot in the first year, 1 plus the forward rate after 1 year for the second year, and the forward rate after 2 years for the third year. So technically 1 plus F03 cube should be equal to 1 plus F01 into 1 plus F11 into 1 plus F1 plus F21. Are you following it? So this is nothing but F03. Means if you invest the money for 3 years, what's the interest rate you're getting? That should be equal to what is the interest rate you get for the first year into 1 plus what is the return you're getting in the second year, which is nothing but 1 year after 1 year. And what is the return you're getting in the third year, which is 1 year after 2 years. And then you can do the calculation. We'll do maybe one more question because I see still some blank faces. But I'll make it more complicated so that you don't get complacent if you get it right. So let's say F04, I'm increasing the number with every next example I'm doing. F04 is, let's say, equal to 6%. F01 is, let's say, equal to 5.5%. F12 is, let's say, equal to 6.2%. Can you tell me what will be F31? Sorry, we are talking French here, language altogether. But I just need a quick answer. What do you think will be F31 before we do the actual calculation? Oh, sorry, guys. Sorry. This is 6.25. And this is 5. My bad. I won't change it further. Sorry. So F04 is 6, F01 is 5, F12 is 6.25. What do you think will be F31? I've not got even a single correct answer yet. Just make sure that you're doing the question with the revised numbers. I've changed some of the numbers. Okay, I've got the first correct answer from Vaibhav. Good one, Vaibhav. What about others? Okay, another correct answer is coming from Varun. Good one. These are the only two correct answers so far. Varun and Vaibhav. And guys, please all of you reply. Don't hesitate, even if you get it wrong, but at least give it a try. Okay, I've got the correct answer from Samay as well. Can any of you, Samay, Varun, or Vaibhav, explain how did you get the answer you got in a very, very layman terms?
So basically, F04
is 6% for 4 years, so that would be 24%.
Right.
F01 for 1 year is 5. F1 for 2 years is 6.25. So 6.25 into 2 will give us 12.5. So 24 minus 17.5 minus 12.5.
Very good. Just to put that in like more detail, if you invest money in F04, technically for the next 4 years, you're blocking that you'll get 6% return every year. This is what you are getting into, right? But if you invest money into the F01, today you will get what you say is 5%. For the next 2 years, which is F12, you'll get 6.25%. And I don't know how much will you get in the 4th year. And this is what we want to calculate, right? So just putting everything in 4 decimal points, sorry, 2 decimal points. So here, if you invest money for 4 years, total you're getting 24%. Here in the first year, you're getting 5. For the next 2 years, you're getting 6.25. Total, you got 17.5. So to make it 24%, you should be getting 7.5% here. If I want to calculate the exact number will be equal to 1 plus 6% to the power of 4. And this should be divided by 1 plus 5% into 1 plus 6.25% to the power of minus 1. So guys, exact answer. 6.5, sorry. Why did I say 7.5? Sorry. It should be 6.5. The exact answer is not 6.5. The exact answer is 6.5065. But very close to what we did approximation. Okay. So please get used to like in your books, what they say, what they call F01 to be 1y, 1y. Sorry, 1y, 1y. They call this to be 1y, 2y. They call this to be 3y, 1y. Okay, so we did this calculation. You know how to calculate the forward rate if you know the spot rate for a couple of periods. Okay. If you plot the spot rates, you get a spot rate curve. If you plot the forward rates, you get the forward curve. And if you plot the coupon rates, you get if you plot the YTMs, you get the yield curves. If you want to do a couple of questions here before we go further, so that you get an idea about it. Let's do this one, okay? The spot rates are 3.2% for 1 year, 3.4% for 2 years, and 3.5% for 3 years. What will be the price of $100,000 face value with a 3-year annual pay bond with a coupon rate of 4%? Now, guys, one thing is important here, okay? That if you invest in this bond, what you'll get in the first year is only 4%. So whether 4% gets divided by using a discount rate of 3.2%, 3.3% and all doesn't matter much, to be honest. In the second year, again, you'll get only the coupon value, which is 4%, doesn't matter much. The most important part in this equation is the 3-year spot rate. Because the majority of your money will be coming in the third year, which is including the bond value. So as a result, if I want to do any approximation, I'll simply ignore first year ka spot rate, ignore second year ka spot rate, and focus on the third year ka spot rate. Third year ka spot rate is 3.5%. The coupon you are getting is 4%. It means you want 3.5%, but you're getting 4%. It means you're getting 0.5% extra every year for the next 3 years. If you're getting 0.5% extra for the next 3 years, you'll be ready to pay almost 1.5% premium. As a result, the answer would be A or B. It cannot be C. because C would mean that the premium is 8%. That doesn't make sense to me. Even between A and B, given you're getting 0.5% extra for the next 3 years, the present value will be less than 1.5%. I will stick my neck out and I would say that B cannot be the answer. The answer is A. I may be wrong, but if I'm like really like in the last second and I have to mark either A or B, I'll mark A. But I'll still try to verify my answer using the calculator because I'm not Einstein here. But given the logic, my preference is for A rather than B. See, it's A. Why did I know like it's why my preference was for A? Because if you're getting 0.5% extra for the next 3 years, the total is 1.5%. The discounted value will be less than 1.5%. And the first and the second year doesn't matter. See the cash flow in the first and the second year is just 4,000. The majority of the money you're getting in the third year. So this is how you look at these questions. So some people may say, "Arey yaar, it's such a complicated question. I have to solve everything." I would say it's the most easy question you can get in the exams. Question number 4. The 4-year spot rate is 9.45%. The 3-year spot rate is 9.85%. What is the 1-year forward rate 3 years from today?
Option A.
Why do you think option A?
Because the 3-year spot rate is higher than the 4-year spot rate, so the difference should be less than the 4-year spot rate.
Absolutely. So in this case, मैं बोल रहा हूँ approximation भी नहीं करना है तुम्हें. So if you invest for 4 years, you're getting 9.45%. If you invest for 3 years, you're getting 9.85%. Why people are happy with the 9.45% in a 4-year? Because they think that in the 4th year, they will lose money. They will get a lower rate. It has to be less than 9.45. And there's only one answer choice, which is 8.258. If you still want to do the approximation, here you're getting 9.45% every year, but here you are getting 0.4% extra every year. So in the next 3 years, you'll get 1.2% extra. So that should be compensated in the 4th year. So you should get 1.2% lower in the 4th year. So the answer should be very, very close to 8.25%. Again, like I would say this is a very easy question you can get in the exam. If you get it, say thanks to the individual, like the person who set the exam paper. And this is the problem, guys. Many people, start finding these questions difficult because they start making it complicated, technical, and they start, going like putting too many things on the calculator without understanding what the question is trying to ask you. Okay. So the next part we are going to do and is about interest rate risk and return. This is a bit of a theory topic, so we'll maybe start doing it in the next class. But guys, I kind of got a feedback like we should be discussing something about CFA as well. I've done lots of those sessions in the previous batch, like in terms of anything about you want to ask about the exams. But people who joined in this new batch, do you have any generic question about CFA preparation, CFA exams? Feel free.
I have one question, Ansh, regarding that, that additional course we need to do. Like, have you got any idea? Like, do we need to complete that before exam or between the result date or exam date?
Yeah, so you have to do it before the results date, right? And I think like well before the results date. But do you have to do it before the exams? Maybe not. So the best way of doing it is like just after you're done with the exams, within a week or two, you complete those additional things. How much time it will take you? Just keep 10 hours aside, and that's it.
Okay, understood.
So the best way of doing it is like you have a momentum getting into the exam, write the exam, party for a day or two, but then continue with the momentum, study for another 1 or 2 days, do those additional subjects, and then you're done. I'll say don't lose the momentum, start preparing for the next level, being hopeful about it. And when you read for the next level, start with ethics because ethics remains the same for level 1 as well as level 2. So in the worst case scenario, even if you fail, whatever you study for ethics will still be useful.
Ethics will be there in level 2 also.
Didn't I tell you? The best part about ethics is that it's there in level 2. It's exactly same 90%. Matlab word by word, line by line, it's same.
And why repeating the topics?
Why repeating? So Souvik, you finding it difficult that ethics being repeated twice in level 1 and level 2? In our investment banking business, if I didn't tell you before, we get a compliance training every month taken by the same person. And I was there in a company for 7 years.
Yeah, I know, like every quarter we also need to do that compliance thing.
वो तो
Every
ऐसे ही just like वो जो online वाला है वो तो just like keep pressing next
no,
next
no,
next
like
without reading it.
course, proper course. Like
अच्छा proper course अच्छा हाँ तो how can you ask that question? And you know the repercussion, right? If you're into this industry, that what if you do something crazy? Like all the banks are busy paying fines. Like they have so many compliance rules. Every time they pay fines because they breach something or the other.
yes, understood.
So I will ignore that question. That why ethics in level 1, level 2. Oh, by the way, it's there in level 3 as well, which is very very obvious.
Same topic, like same topics, or
I don't remember like level 3. I've not looked into like in from last couple of years, so I don't recall. But level 1, level 2 is like 90% same. There's some extra topic which is being there in level 2. That's it. But your core ethics remains exactly the same. Oh, don't get excited. Though the course is same, but the questions will be even more confusing. So if you want to prepare better for level 1, do the questions from level 2 for ethics. The course being same, you'll understand what's the actual confusion or the complexity level when you get into level 2. Any other question before we call it off? Rishabh, I must say one thing that man, like I was like a bit concerned that given you do not come from a finance background and you didn't attend the initial few classes, I had all my eyes on you, but you're really like cop up very well in terms of answering questions and everything. So that's good.
That's because I told you right in 2021 I attended.
Right. Good. Any other question? Any doubts?
I have one doubt. Ansh, like if you remember last day we did a question regarding that number of difference between a high yield bond and long term high yield bond and
Yeah.
investment grade bond.
Yeah.
So we concluded on that like the high yield bond will have more covenants.
Yes.
But like I was not 100% sure because like it is a high risk bond because like there is less covenant like
No,
in an
no, no, no.
investment.
So think about you giving a money to Mr. Ambani versus giving money to me. Or let's say you go and give money to SBI Bank for a fixed deposit. Do you discuss a lot? अरे कब अगर ये होगा तो क्या होगा? If I do this, what will happen? Make sure that you don't give loan to others. No, you simply give the money, walk off. But if you give me money, acha, what will happen if you die? What will happen if you don't die? What if you do with this? Like there'll be so many covenants you'll get into the agreement for. So when the uncertainty is more, you need more things to be written on the agreement. High yield bond are not high yield because the covenants are weak. The high yield bonds are high yield because you are giving a loan to somebody who does not have a strong financial background and you do not trust that person enough. And when you don't trust the person enough, you want to get more and more things in writing.
Okay, understood.
I have one question. Topics from quants like, let's say, probability hypothesis and simple linear regression, where I'm finding a little bit of difficulty, slight difficulty, I would say. These topics are going to be used in which further topics?
Your question seems very loaded, Leah. If I say it's not going to be used anywhere else, are you going to skip those topics?
No, not at all. But then I wanted to understand the flow of my preparation, basically.
Okay, if this is where you're coming from, nothing else is dependent on those topics.
Okay, sure. Thank you.
Except correlation part, but correlation is done even outside the regression topic.
Okay.
So correlation is something which is important somewhere in portfolio management.
Okay, got it.
Otherwise, hypothesis testing, the only time we discuss about hypothesis testing is when we are in quants.
Okay, understood.
Okay?
Understood. Yeah, sure. Thank you.
Guys, I've rolled out the feedback form. Please do fill it before you log off. And I'll request the institute for one additional class so that will complete fixed income next Saturday and Sunday.
Thanks, Ansh. Logging off.
Thank you, guys.
Thank you.
Enjoy the weekend.